Hello, Tom. Can you hear me?
Yes,
Can you see me?
I see the thing that says,
Sharing your PowerPoint as we start. Mr. Chairman, I think we're ready to go. Yeah, thanks.
Thank you very much. We'll call back to order and start with the economic forecast. Mr. Jackson is on the video virtually and will give his presentation. Mr. Jackson, the floor is all yours.
all right, thank you. Can you see my screen right now? There we go. Great. Well, thank you. I apologize for not being there in person. Would have loved to have been. But we'll get into it. I don't want to give a whole history lesson of the last 9 months or year or so. You folks know that as well as I. But one thing I want to do to kind of put the present downturn in a little bit of context, especially with, you know, we had kind of just been able to stop talking about the last recession over the last few years, but kind of going back to comparisons and kind of look at the more recent one, just show the magnitude of it, but the at least hopefully short duration of it in terms of the downturn, but then the rapid, partial recovery. Even with all this, we're still below where we started off back at the beginning of the year. But we certainly hope that this, at least the early recovery won't be as drawn out as the one 12 years ago. Just had very different causes, and so the implications will be different. Um, just kind of showing, and this is a national view here, just kind of show, the disparate impacts by industry. Leisure and hospitality really stands out. I think we all know that, restaurants, hotels, that kind of thing, just so much of the travel and tourism sector. Really, well, the federal government one at the top is a little bit of an odd case that's been inflated just by the hiring for the census that occurs every 10 years. That kind of creates an outsized effect with the seasonal adjustment process, kind of exaggerates that. But certainly some industries, especially things like financial services, were largely able to keep going through this. A lot of folks are able to work from home, that kind of thing. Transport and warehousing has been really an interesting one, that some aspects of that have really boomed through this, particularly from say May and June on, when things were able to get going again. More the freight goods delivery part of transportation has really done well, but anything involving transportation of people, whether it's airlines, certainly mass transit, um, taxis, all kind of things, passenger railroads, just doing very poorly as people just not traveling that much, certainly not in groups. So, construction was able to get back on the job pretty quickly. So, just kind of an overview of the national view. Now, the state of Indiana's view is a little bit different. We'll show that later. Uh, this is just a brief synopsis of kind of where we are, more very recent thinking in terms of where the national outlook is going again, GDP, this is all historic, unprecedented, whatever you want to call it, in terms of, the sharpest rise. But again, even after the third quarter increase, GDP below where it was, 3.5% below where it was. So much of the outlook for the short run has depended on really a couple things. One is, when can we kind of get some of the effects of the virus behind us? And then another thing really is, the where are we with additional federal stimulus? You know, we had just a huge federal stimulus back in the spring, really was very supportive of consumer spending, helped many parts of the economy keep going, and particularly for folks who are out of work, lower income people. You know, one of the big factors there was that really, 100% of that money was being spent. Um, there's various evidence being presented that folks who were able to maintain their incomes, some of the relatively higher income folks, more of that went into savings, and then of course there were certain parts of the economy where on which you couldn't spend money if you wanted to. Things were just closed, couldn't get out and do things. A lot of that started to rebound in June and especially into the third quarter. But really, you know, recent news on the vaccines has been about really about on par with what we'd been thinking, probably a little bit sooner than maybe we had been thinking in terms of the assumptions underlying our forecast for 2021 and moving forward. But really, we were expecting something certainly by spring. So, but just to have, kind of confirmation of that or, more confidence of that uh, really has provided a boost. And then, still the negotiations over additional stimulus, still kind of up in the air, but we are, have increased our confidence. Really, back in November, we had taken further federal stimulus out of our forecast entirely. That was the first time we had done that. But we've put that back in, just some of the extra unemployment benefits, on top of the other, and some extension of a little longer term unemployment benefits being a big factor there. And then just in terms of really getting back again, just kind of this return to peak idea. When do we get back to where we were? Um, Real GDP gets back in the third quarter of 2021. That's about as early, with our various forecasts over the last 9 months. That's about as early as the crossover at the national level has occurred. Full employment, more like mid 2023. It's a little bit longer. We'll get into some of those factors, but the big thing is just some really high employment sectors of the economy just having trouble getting fully back to work. Again, policy assumptions already kind of covered some of this. Certainly the extending some of the unemployment benefits and really getting and a big part of that, and again, something we try to stress is that this is money that will be spent immediately, or really in a lot of cases has already been spent, and being used to pay bills, sometimes overdue bills, that kind of thing. So this, this money does, go directly right back into economies, many times local economies. So we see that as supportive of spending. Um, and certainly, possibility of government shutdown with, spending bills. We're largely discounting any possibility of a government shutdown from now. Still, not really longer term agreements going on there. State and local government spending, which is part of why you folks are here. Certainly, some restrained spending there, having some impact on employment and on other factors. Um, the Federal Reserve, again, basically just supportive. I'm not really well versed in a lot of the details of the Federal Reserve uh, policies, but the main thing is just supportive in terms of interest rates, other types of activities, just about as supportive as they can possibly be, really for the foreseeable future. No real threat of pullback there, I think is the bottom line there. In terms of the state of Indiana, it's really been interesting. Indiana had, along with a lot of neighboring states, had some early, shutdowns. Had some had some outbreaks, neighboring states had outbreaks, and of course, so much of it was just not really, knowing for sure what we were dealing with, that kind of thing, how to deal with these things. But after a couple of months, with relatively low caseloads, Indiana was able to, um, you know, eliminate some of those and certainly back off of a lot of those lockdowns. Manufacturers, with Indiana being such a heavily manufacturing state, manufacturers, the ones who had shut down, particularly car makers, had shut down for a couple of months, starting in mid-March, were able to get back going again. That was a big help. Travel and tourism, a relatively low share of the economy. I don't want to overstate that. I know, especially with the city of Indianapolis, had many real big activities. Um, Canceled, not able to have crowds at things. Some very visible, but just in terms of the overall share of the economy, um, you know, really took a little bit of less of a hit there. And the other thing I'll say, particularly in terms of the manufacturing that was a wild card early, was not just being able to get back to work, but really having that demand base being there. Some of that was supported by, some of the stimulus money, but also really just the ability across the country of so many people to be able to keep working through that. I mean, it's great to say that, yeah, you can get back to work, but if there's no effective demand, if there's not people buying what you're producing, then you won't stay back at work for a long time. We knew that initially there was a lot of backlogs, inventories needed to be filled, that kind of thing. But really, was able to pretty quickly get back, get some supply chains back up and running and really able to get things. And that's just been a huge key, particularly for the state of Indiana, I think, in being able to come out relatively well throughout the early part of this. Um, Having said that, I think from here, both nationally and within the state, the rate of gains are going to slow down. Kind of done. I don't want to say the easy part. Perhaps pick some of the lower hanging fruit in terms of being able to get things back to work. We don't expect federal stimulus to go on forever. I think really this next slug here in the first part of 2021 mainly be about it. Some continuation. But then some of the loan programs and things like that. Have a little bit longer tail for some of the businesses also. But just certain industries, especially things related to travel and tourism, just going to really take a long time to fully reopen, and they tend to be, have just a lot of people working for them. We expect the state's employment for Indiana to return by mid 2022. Real GDP by early 2021 was kind of right around the corner again. Kind of that manufacturing goods producing base, a big part of that. In terms of industry structure, productivity gains, we can talk about that later. I certainly welcome questions on that. In terms of, things have changed a lot in the short term. How many are going to be temporary changes? How many are going to be permanent changes? Um, we can certainly talk about that. I think for right now, the main thing I'll say is that we're taking a pretty conservative approach, or at least I am, to kind of what we're really going to see in terms of long-term structural changes. But I'll certainly entertain questions on that at any point. Um, Again, this is just another illustration of the point that state of Indiana, was able to come back relatively early, partly due to industry structure and just fewer, really able to get that number of caseloads relatively under control a bit better early on. Um, and then probably not having, certainly early on, a lot of the really concentrated urban areas had a lot of problems. It's since spread to more small town and rural areas than we had up front. So, but that's still been a relative advantage for the state of Indiana. As we get into 2021, 22, that advantage starts to fade a little bit. Really, other areas start to catch up, particularly as we get widespread effective vaccinations. As part of what we're assuming, but still some positive growth moving forward, and by 2023, 2024, getting back to kind of our earlier expectations for the economy at that point. Some of the key indicators for Indiana. One thing I've found interesting through this and had to get used to a little bit was that personal income line, the one that highlighted in red there a little bit. In 2020, personal income actually being up by 6% compared to the previous year. A lot of that is the federal stimulus money, the extra money coming in. And the other part is, wage income really being down by a relatively small amount, maybe relative to what you'd expect. I think even with payroll employment down so much, one of the odd, there's been just a lot of, kind of statistical oddities, odd looking things coming out of this. Part of that is with so many of the lost jobs being in lower income sectors, we've really seen kind of that average wage per employed worker really go way up. And that's a function of not just wage rate, but it's also number of hours worked. It can incorporate overtime in that. So just a number of things really maintained, relative wages for those people who are able to continue working or get back to work pretty quickly. But then as we get into 2021, that situation kind of reverses. Wage income stays relatively high as you get more people back to work. Personal income gains come down quite a bit, though. We normally expect a more positive correlation between income and personal consumption expenditures, but again, in 2020, the savings, the implied savings rate went up so much, largely because people had money and in some cases were probably reluctant to spend it if they didn't have to, but in other cases just couldn't do things that they really wanted to do. So we would expect to see some of that catching up in 2021. Unemployment rate, problematic as usual, kind of in my mind in terms of the effects of changes in the labor force on that, but generally decreasing, being relatively low, coming back down. This, I took this slide from Opportunity Insights. They've done some really great work on compiling some, kind of unusual data sources, kind of high frequency data. This illustrates really what we've been calling kind of that K-shaped recovery, where, you kind of have lines going in different directions. And basically what that means is that, certain parts of the economy recovering really pretty well, other parts, having a very difficult time coming back and having kind of divergent paths. This shows, employment relative to the January level, for relatively high wage earners, middle wage, and especially those low wage earners, kind of came up till about, July or so, and very much leveled off since then. So that just shows some of the challenges ongoing and really getting that portion of the labor force back to work, is kind of the unfinished work in terms of getting the full economic recovery and getting things back to where they were. Again, Indiana's industry struggle. Again, remember that with the U.S., leisure and hospitality was the big one with with the state of Indiana, it's manufacturing, and even with that, the numbers have been relatively good. I think, there's certainly some sectors that are still having trouble getting back on the beam. workforce issues, a number of places in terms of, keeping people healthy, um, working parents having trouble, in some cases being unavailable for work, helping their kids with online schooling, that kind of thing, creating some problems. But basically, leisure and hospitality came, and this is one that, as we kind of go through our forecast reviews, comparing all the states a couple of times, my colleagues would say, Indiana looks high on the, leisure and some of these sectors. I said, well, that's that's where it already is. That's not me projecting forward. That's where it is now. So, that's been interesting in looking at kind of comparing the states. Again, transport and warehousing, that's reflects Indiana's relatively high share of freight goods transportation, um, relative to, probably more passenger transport um, areas. So that's been relatively good. So it's just kind of a brief snapshot that I show kind of every time we're together. Vehicle sales, a big one for the state of Indiana. So, and this is U.S. vehicle sales, but certainly Indiana's producing for the whole country. Probably a lot of ways it's come back, relatively well. Light trucks and SUVs continue to be the big seller. One thing holding back car sales, it has been a lack of fleet sales, things to rental car companies, state and local governments, the businesses that still have their fleets of cars has been holding back sales of cars there. But we expect that to be fairly sustainable at the current level. Housing starts have really bounced back. I think a lot of you folks know the story on that. Low interest rates, um, you know, families, the ones that are able to, really maybe trying to get out of apartments, get a little more distance between themselves and neighbors, need more room, with need an office space for people working from home, kids doing school. Hopefully a lot of that is fairly short term, but folks are able to do so really, trying to get back and getting into their own homes. And some of this still probably represents pent up demand from over the last 10 years as well. But, certainly been a positive aspect for the economy, in the latter half of 2020 and certainly will be into 2021. Again, this is another little snippet I grabbed from Opportunity Insights. I want to give credit where credit is due there. Again, just show, there's all kind of categories they have, but to really show, overall spending near where it was back in January, but entertainment and recreation being a huge decrease. And again, that's something that will need to come back in order to get the economy back kind of fully going. Okay, the bottom, I have more slides as usual. I don't intend to really show them. They're kind of informational for you, so I'll spare you the rest of the slides in the deck. Kind of just want to sum up a little bit. I think, again, just reducing virus spread and just its impacts is a big thing moving forward. Kind of had a second surge or whatever you want to call it. Getting kids back in schools is a huge issue, not just for their own education and for their future workforce, but even and that's the biggest issue. But also to allow parents and others, to themselves get back more fully into the workforce at times, and then just getting the virus under control, getting folks back able and comfortable to travel, do more of those leisure things, and sometimes just some of the higher touch other services that have been slow to be able to come back. Return to offices is a big wild card. I don't have strong opinions on that right now, but but certainly getting people back into the office spaces, particularly in Indianapolis, but just in a lot of downtown areas, has a lot of implications for restaurants and other businesses that have, also congregated in those areas to meet kind of that, whether it's lunchtime demand, doing things after work. Um, Folks like me doing last minute Christmas shopping across the street from the office, that kind of thing. Um, Getting that back going again needs to happen to get a more full recovery. And we do expect, vaccinations, more effective treatments, that kind of thing to help with that as we get into the second half of 2021. Another factor that hasn't been, and this really really my last point, um, another thing that hasn't been discussed much, but at least needs to be brought up probably is, you know, there are a lot of there's been a lot of mortgages falling behind, rents falling behind, that kind of thing, and so I think that'll be another aspect of this to avoid getting more into a situation that we were in 10 or 12 years ago, in terms of just having a lot of those kind of cascading financial impacts. If one company is expecting, or person or company is expecting payments from somebody else, not getting them, well, they have their own bills to pay. At what point does that start to cause bankruptcies, other things like that, and just what cascading effect does that have? So there will probably be some policy work to be done there to try to address some of those effects that we probably haven't heard as much about yet as we will. So with that, that's probably the extent of useful comments that I have for now. I'd certainly welcome any questions, points of clarification.
Thank you, Mr. Jackson. You talk about the health of the economy and fighting the virus. Did you look at that specific to Indiana also, and whether the state of Indiana has kind of a moderate to moderate negative take on the vaccine?
Well, in terms of vaccine acceptance and that kind of thing, I really have not. That's, I know that's been a topic of discussion, and certainly, one of the big issues with all that is that, a lot of it has been, whether it's personal response to caseloads, um, political responses to rising caseloads. Just some, state and local governments have been quicker to, um, implement restrictions. But even beyond the issues of restrictions is still, kind of the personal thing of what are people going to do. Um, I'm not saying, I'm talking about people breaking the law and things like that, but sometimes even if people are allowed to do things, they're still not going to do them for a while. I think in terms of the state of Indiana, it's always hard to generalize it. It seems like the state of Indiana has been more apt to try to maintain business as usual, both, kind of politically and, on a personal level. Um, and again, I think other places are probably been a little more cautious on things. Again, it depends very much on, um, population densities at times. It has a big role in that. But in terms of, people lining up to get vaccinated and that kind of thing, um, I've had cases even close to home where, people have differed on response, even as people have, had the virus, and really what the appropriate response and what people are going to choose to do.
Okay. You seem rosy for the future, or at least a positive trend. Is that a strong possibility? And what's the possibility that we would fall off and go negative in the future?
Well, there is a wide range of possibilities from here. I think, again, we do feel like, the advent of the vaccine and at least being hopeful that, whether it's through widespread vaccination or even if it's, partial vaccination and just, really getting more effective treatments, that kind of thing, that, I think once we can get past a lot of the more initial concerns, over the next few months, really, then I think we do see a good bit of pent up demand. I think we saw it this past summer that, people are willing to get back to doing what they can, and with consumer spending being like, 70% of the overall economy, um, that's a big factor. But we think we've seen plenty of reason, I think, to be optimistic about that based on what we've already seen. Really, I think in some ways it's been better than expected. Like I said, policy responses are going to be a big one. There's still a lot of work to be done, to me, in terms of, kind of financial, personal finances, business finances, dealing with, just a lot of the, bills that are past due, kind of behind, when does that all come due, and how does that all get handled? I think, in some cases, if that takes a very hard line, then, that can result in some disruptions that could push things negative again.
Okay, thank you. Further questions of the committee? Mr. Jackson.
Thanks, Tom. I'm just curious on some of the assumptions. I mean, I'm looking, for example, at the kind of the extension of the unemployment benefit assumptions. How important is that in terms of your overall projections? And if Congress would not make those extensions, I guess how would our outlook respond if some of these assumptions don't pan out as you've expected here?
Well, it would be relatively short-term effects. Again, I apologize. I should have really last month's forecast in front of me also. Certainly at the national level, I think the difference we were talking about was, 1% of GDP or so. But, I apologize. I'm not going to try to cite numbers off the top of my head. I can work with Hari on getting that to you. It would be it's a fairly short-term impact on that, but certainly has some impact on consumer spending, for especially the first part of next year.
Further
But
questions?
I just say we wouldn't see that as some kind of a backbreaker for the, state economy or for the national economy if that doesn't happen. But it would cause some short-term, declines.
Thank you. Senator Melton?
Thank you, Mr. Chair. Thank you, Tom, for your presentation. With transportation and warehousing, since that's on a positive trend, as we transition back into kind of normalcy, do you think that would change and shift as people's spending habits will shift probably more from purchasing remotely or online to more back to traditional ways? Do you see that changing any, or would there be a consistent move forward?
I think we see the momentum slowing, particularly probably on the delivery to homes, that kind of thing. I don't think we see that, particularly since, some of this is a continuation of a trend that was already occurring, particularly in terms of, retail shopping and things like that. People have gotten fairly accustomed to that, I think. So we would see momentum slowing in that area. But, of course, another portion of the transportation, freight transportation is, movement of things, just for, to keep the economy going, whether it's, parts, kind of intermediate parts for, manufacturers and that kind of thing. And so we certainly see that part continuing. There's also a long way to go in terms of really kind of getting trade flows, international trade flows, back to normal after huge disruption. And so there's a lot of room to run yet on that part of the economy. So we still see that being pretty positive.
Further questions? Senator Faddy.
Thank you, Mr. Chair. Tom, thank you for your presentation. I have a couple of questions. Consumer spending is projected to be negative first quarter of 2021 without a stimulus package. Are you referring to a federal stimulus package or state stimulus package? And if it's the federal one, have you seen other states enact state stimulus level package to increase consumer spending?
We're talking about federal at that level. States, we haven't seen too much at the state level that I'm aware of, and I think a lot of it is just they're stretched very thin as it is. Very much really waiting for federal stimulus.
Great, thank you. My second question, you mentioned that we'll be reckoning with financial fallout from lagging payments for mortgages, rents, and credit cards, and so on. The National Coalition, National Low Income Housing Coalition recently published some estimates that here in Indiana, Hoosier households are at risk of eviction due to COVID-19. The real-time estimated shortfall of rent in Indiana by January 2021 is estimated to be between $152 million to $284 million, and that will impact 41,400 households up to 79,900 households. Have you seen other states, whether on a local level or on a state level, enact any policies to basically avert this crisis that we know it's coming on a national level and on states levels?
I'm not aware of many, and that's really why I raised that, at least as something yet to be seen what happens there. But no, I really can't cite very many examples where it's happened already.
Great. My final question, I know that your role is to share with us your analysis as an economist, and it's our role as a General Assembly to debate and come up with good policies. Have you seen, or do you have any recommendations of policies that you've seen from other states that worked in the last few months to protect their local economies that you may recommend for us as a General Assembly?
Not too much. We've really been more focused on the national level. Certainly just a big, just deciding what to do. Is more than ever, a political process. There are costs and benefits. I think the main theme for all the states has been just kind of limited resources to do new things. Make any kind of new commitments. I haven't seen too many, particularly in terms of kind of longer term efforts. There's been talk, certainly things like, restaurants and things like that have been looking for aid, but, so much of that, really has been, kind of shut back more to, well, talk to the federal government about that. So no, there's a lot of work to be done on that yet.
Any further questions or comments? Thank you, Mr. Jackson, for your time, and thank you for being with us today.
Well, thank you.
Next, we'll go to Hari and Ben for the revenue forecast presentation.
Okay, well, good morning, Mr. Chairman, members of the committee. My name is Ben Tooley, and I'm the Director of Fiscal Policy for the House Republican Caucus. To my, far right is Hari Razafindramana. Hari is the Assistant Director of Revenue at the State Budget Agency. Now that Tom Jackson has given you the economic forecast, Hari and I are here to present you with an updated revenue forecast for fiscal year 2021, and for the first time, a brand new forecast for fiscal year 2022 and fiscal year 2023. But before I dive into the slides, I always like to do this when I present. I like to say a few words about the Revenue Forecast Technical Committee. I want to say a few words about the committee and its members and staff. The charge of the technical committee is to select the equations that are used in the revenue forecast. Those equations are matched up with the economic variables presented by our economic forecasting consultant, who you just heard from, to predict future general fund tax revenues. The technical committee is a 6-member bipartisan committee, and like the budget committee itself, is a collaborative effort between the legislative and executive branches. Most importantly, the revenue forecast is a consensus forecast, which means that all of the members of the committee agree that what we present to you today is our very best effort at projecting the amount of general fund tax revenue that the state will collect this fiscal year and in the upcoming biennium. Aside from Hari and myself, the other members of the committee are Eric Gonzalez, fiscal analyst for the House Democrats, Susan Preble, fiscal analyst for the Senate Democrats, Krista Ritchie, senior fiscal analyst for the Senate Republicans, and I don't think she's here today, but Dr. Dagny Falk, who I'm sure is watching online. She is the committee's independent economist from the Miller College of Business at Ball State University. Also want to give a special thank you to the staff of the State Budget Agency, some are sitting in the back, and also the Legislative Services Agency, who play an absolutely vital role in the process. The work of the committee absolutely could not get done without their efforts. And then one last thing I want to say is I want to thank the Budget Committee as well for your continued support of the independent, nonpartisan, collaborative process by which Indiana estimates future tax revenue. I personally believe that our process is the gold standard that all other states should follow, and you as the fiscal policy leaders for the state of Indiana, I think, get a much better product as a result of that effort. So just want to thank you for your continued support of the process. Moving on to slide 3 in your packet, this slide shows how revenues have performed through the first 5 months of fiscal year 2021 as compared to both the December 2019 forecast and the same period revenue in fiscal year 2020. As you can see from the slide, the big 3 major tax sources, sales, individual income, and corporate, which together account for about 92% of our forecasted revenue, are all trending above the December 2019 target and above the same period in fiscal year 2020. Sales tax revenues are currently about 6.7% up as compared to the same 5-month period in fiscal year 20. So what we're talking about is July 2019 through November 2019, which is of course a period of time that occurred prior to the pandemic. Individual and corporate income taxes are also well above the December 2019 targets and same period revenue in fiscal year 20. But as I will discuss in more detail later in the presentation, much of that amount above target and prior year is attributable to the delay in the income tax due date, where we moved from April to July, which also happened to shift revenues from fiscal year 20 to fiscal year 21. Finally, total revenues are currently outpacing the December 2019 forecast targets by about 13.8%, and the same period fiscal year 20 revenue by 18.4%. But again, these growth rates, they're really attributable to the significant impact of the income tax due date delay. Slide 4 gives you a high-level overview of the economic factors that influence the general fund tax collections. I'm not going to dwell on this slide since you have already heard the economic forecast, but suffice it to say that the broad economic trends outlined here are driving the overall direction of the revenue forecast. Battery is low. No, there we go. A little laggy. Thank you. Slide 5 lists some of the major tax policy factors that impact the revenue forecast. Please keep in mind that our revenue projection models generally forecast the tax base, which is independent of the tax rate and the way in which collected revenues are ultimately distributed. After the tax base is forecasted, the actual amount of revenue that finds its way to the general fund is dependent on the tax rate and the way in which those funds are distributed once collected. As you can see from the slide, general fund revenues for the years covered by this forecast are impacted by a handful of significant tax policy changes and by continued reductions in the corporate tax rate and the financial institutions tax rate. Awesome, thank you. Moving on to the models, slide 6 lays out the variables that comprise the models used to project the big three tax sources. There's a lot of information there. A lot of those variables were discussed, some of which were discussed by Tom Jackson in his presentation. Essentially, though, one key takeaway is we essentially use the same models for this December 2020 forecast as we did in April of 2019. There may have been a few changes there, but definitely they're very similar to the models that we use for the December 2019 forecast. So essentially what that means is we felt pretty confident in how the models were reacting to the changes in the economy. Slide 7 shows the additional out-of-model adjustments that the committee made to various components of the forecast to incorporate revenue that is not implicitly captured by the models. The committee makes out-of-model adjustments to recognize recent tax policy changes that are not captured within the historical data sets or to account for the unique or one-off circumstances. For example, in the case of the sales tax, the adjustments listed on this slide were made to capture the impact of the marketplace facilitator tax compliant legislation enacted in 2019 and the impact of the Wayfair Supreme Court decision. For the April 2019 and December 2019 forecasts, the committee based their adjustments on actual data provided by the Department of Revenue, but then for future growth, we applied basically a simple trending factor to capture the growth in those sources. However, the rapid growth of e-commerce, as Tom Jackson mentioned during his presentation, this is, and definitely has accelerated quite a bit in the last handful of months. It's really highlighted the need to implement a more scientific approach. Therefore, for the new forecast, the technical committee used the expanded historical data set now available from the DOR to create I'm going to call it a mini model of sorts to better estimate the future growth of sales tax revenue attributable to Wayfair and the marketplace facilitator legislation. And then slide 8 is a visual representation of how some major tax policy changes have impacted sales tax revenue. We thought you would all appreciate a visual representation of how these policies are impacting the sales tax revenue flow. And I will say that I'm focusing a lot on sales tax because I think for the first time, if I'm not mistaken, this is the first forecast where sales tax actually makes up 50% of our forecasted revenues for the upcoming biennium. So that's kind of a significant marker to note. As the graph shows, GUT, and let me explain GUT. GUT is gasoline use tax. The deposits into the general fund are declining over time, but that is because those funds are gradually being shifted from the general fund to road funding accounts per the legislation that was passed in 2017. There's also been, because of lower gas prices and lower consumption, there's also been a slight drop off on those revenues as well. The state began collecting Wayfair-related revenues in fiscal year 19 and the marketplace facilitator revenues in fiscal year 20, and the new forecast is predicting a further ramp up in those collections over the course of the new biennium. In total, Wayfair and marketplace facilitator tax compliance revenues are expected to reach nearly $472 million in fiscal year 2023. While significant, do keep in mind, as you can see from the chart, those two sources account for about 5.3% of overall sales tax collections. Now, this is what everybody's actually here to see, not me drone on about these other charts. This is the actual results from the forecast. Whoops, a little too, there we go. So slide 10 shows the new revenue projections for the sales tax and the individual income tax, and also the corporate income tax, and it compares those revenues to the prior year and the December 2019 forecast. I want to call your attention to a few key takeaways. First, you will see that the fiscal year 21 forecast for sales tax collections has been increased by 10 million as compared to the December 2019 forecast, and that the year-over-year growth rate from fiscal year 20 to fiscal year 21 is estimated to be 5.3%. As illustrated on slide 3, way back in the presentation, sales tax revenues are currently trending about 6.7% above fiscal year 20. So this increase in the forecast for 21 over December 2019 is generally in line with current revenue trends. Second, the fiscal year 21 forecast for the individual income tax has been increased by 577 million as compared to December 2019. Year-over-year growth rate is expected to be about 32%. As I mentioned earlier, the large increase in individual income tax revenue between fiscal year 20 and fiscal year 21 was caused by the delay in the income tax due date from April 2020 to July 2020. The delay ultimately shifted about 885 million of individual and corporate income tax revenue from fiscal year 20 to fiscal year 21. Of that amount, about 727 million was attributable to the individual income tax. What that means is that the state will collect about 725 million more from the individual income tax within fiscal year 21 that it would have otherwise collected had those revenues not been shifted across fiscal years. So if you were to net out the delayed individual income tax payments out of the fiscal year 21 forecast, the underlying individual income tax revenue stream that's actually attributable to fiscal year 21 would total about $6,246 million, an amount that is 4.1% more than what the state would have collected in fiscal year 20 had the income tax due date not been delayed. Similar situation is true for the corporate income tax. Because of the delay, the state will collect $158 million more in fiscal year 21 from the corporate income tax than it would otherwise have collected. Net of the delayed payments, the underlying corporate income tax revenue stream is projected to total about $724 million, an amount that is 4.8% more than what the state would have collected in fiscal year 20 had the income tax due date not been delayed. I understand that was probably a lot of numbers and confusing. You're in luck. I have a chart here and just a couple of slides that will hopefully help explain that situation a little bit better. Moving on to the remainder of the taxes. Slide 11 shows the revenue projections for gaming taxes and the other taxes revenue category. Gaming taxes as a whole are expected to partially recover in fiscal year 2021, but are not expected to return to the pre-pandemic collection levels until fiscal year 23. Of course, fiscal year 2020 was a remarkably bad year for wagering tax collections, as riverboats and racinos were closed for at least the final 3 months of the fiscal year due to the pandemic. Even with growth, riverboat wagering tax revenues in 21 are expected to be about 52 million or 16.7% lower than what was actually collected in fiscal year 19. Racino wagering tax revenues in fiscal year 21, on the other hand, are expected to be slightly higher than in fiscal year 2019 by about 7 million or 6%, but the recovery to the pre-pandemic levels is driven by, at least in part, by a state policy change that allowed racinos to offer live table games as of January 1st of 2020. The casino closures in fiscal year 20 will also have a secondary impact on wagering tax revenues in fiscal year 21. Because of the closures in fiscal year 20, there were a few more, and I don't have the names of the boats, but there were a few more riverboats who should qualify for the small riverboat tax bracket in fiscal year 20 that applies to riverboats with 75 million or less of annual adjusted gross receipts in the prior fiscal year. And of course, those tax rates are a little bit lower. On the other category, the biggest driver of the decline that you'll see of 6.2% on the slide is a fairly substantial decrease in the amount forecasted for interest revenue to the state of Indiana. And basically that's interest that's earned on state-held funds. That forecast for fiscal year 21 has been lowered from 95 million to 37 million, decrease of 58 million or 67% as compared to the 2019 forecast. And then we further project that it'll decline in 22 and then increase slightly in 23, but of course that's all function of the current interest rate environment. Overall, total forecasted tax revenues are expected to grow by 15.3% in fiscal 21 as compared to fiscal 20. declined by 2.9% in 22 as compared to 21, and then increased by 3.0% in fiscal year 23 as compared to fiscal 22. And again, the year-over-year volatility between the three fiscal years covered by this forecast is affected pretty significantly by the $885 million in deferred income tax payments shifted between fiscal years. So just a couple more slides here, and then we'll open it up for some questions. This slide, you can look at it a little more in depth later on, but it's basically just intended to give you a visual representation of the impact of shifting revenue between fiscal years. So if you look at fiscal year 20, the dark blue bar represents the actual revenue collected on an as-received basis in fiscal year 2020, and the light green bar on top represents the amount of tax revenue that was shifted to fiscal year 21. For fiscal year 21, the dark blue and light green bars together represent the total amount of revenue that the state is now projected to collect on an as-received basis in fiscal year 21. The dark blue bar, on the other hand, represents that underlying revenue stream that would actually be attributable to fiscal year 21 had it not been for the income tax due date delay. The point that the chart attempts to make, that is, if the deferred income tax payments were assigned to the year in which they would have normally been received, the change in revenue between fiscal 20 and 21, and then also between 21 and 22, would not have been quite as dramatic as it might first appear. Then one last chart to illustrate this point. You'll see on the left, that is the actual and forecasted tax collection amounts from fiscal year 20 through 23, as updated by this forecast, and you'll see that the changes are pretty dramatic, down 6.3%, up 15.3%, down 2.9%, up 3%. The part of the chart that's on the right, however, adjusts the 20 and 21 revenues to put those deferred payments back into the year they would normally have been received. And if you look at it that way, the change in revenue has not been quite as volatile as it appeared originally. So down 0.9% in fiscal year 20, up in fiscal year 21, and then a steady incline in 22 and 23. So again, that's just meant to give you kind of a better picture. We tend to get boxed into fiscal years, and in this case, because of this unusual situation, it's probably better to look a little beyond that fiscal year box just to have a better understanding of what's really happening with state revenue. And then last but not least, slide 14 is the combined statement, which shows you the data included in slides 10 and 11 in one convenient but very difficult to read chart. This year, the combined statement contains two additional columns highlighted in yellow that adjust revenue in both 20 and 21 for the impact of the deferred payments, as I just illustrated in the previous slide. However, please keep in mind that the dark blue columns, that's what represent the actual and projected revenues that were or will be received by the state within each fiscal year. Of course, once you get to 22 and 23, you don't have to worry about deferred payments. There's no impact there. The remainder of the slide packet contains appendices with charts showing the trends in the variables that are incorporated into the various revenue models. For those watching online, this presentation, the economic forecast presentation, and all supporting documentation are available on the Budget Agency website. That is what Hari and I have for you today. Hari and I are happy to take questions. In fact, I know that Hari is itching to take questions. So anyone who can stump Hari gets a prize at the end of the presentation.
Actually, I did want to add, thanks, Ben, for your presentation. Relative to those questions that we received with Tom Jackson, I just wanted to provide some additional feedback there. So there are always scenarios that we look at as part of every forecast. We have a baseline, an optimistic, and a pessimistic scenario. The probability of pessimistic was 30% compared to baseline of 50%. Just for perspective, 2020 under the baseline sees a GDP growth of contracting by 3.4% compared to the pessimistic sees GDP contracting by 3.5%. And that's understandable because 2020 is about to end, so the forecast shouldn't be really different between the baseline and pessimistic at this stage. But really the difference is in 2021 where the baseline sees a 4.3% growth versus 3% under the pessimistic scenario. And a lot of that is under consumer spending, where 5.2% growth is estimated under the baseline and 3.9% under the pessimistic scenario for 2021. And a lot of those assumptions really, we've worked with IHS Markit and Tom Jackson to really try to incorporate those. And those assumptions have changed dramatically, as you can imagine, from April to December due to all the things that happen at the federal level, but also the developments on the health front. And I can just tell you from perspective that the same models that project this forecast that you see today forecasted a number that was about half a billion to $1 billion lower in April. And that just tells you a lot of uncertainties there. And a lot of that can change depending on what Congress does and a lot of what happens. And I think to Zach's question, how the unemployment update in December affects this forecast, we've seen our models change by about $100 to $200 million over the last month. So it is an impact, and a lot of that is also related to the vaccine news, et cetera, but it's not a huge impact in the grand scheme of things. Thank you.
Thank you. Questions for Ben or Hari? Senator Melton.
Thank you, Mr. Chair. Thank you both for the presentation. Quick question in terms of, I asked IEDC this yesterday in terms of the number of businesses in the state that was approved for PPP loans. Will the state of Indiana look at, for those that were forgiven those loans, will we look at that as added income for them? I'm just curious.
I think I'll let Hari answer that question. I think that's a policy question, depending on just how the federal government reacts and then how our state tax code interacts with the federal government. But I think maybe Hari can shed a little insight in terms of that connection as it stands today.
Definitely. So obviously there are some special dynamics going on with the state of Indiana. Our corporate and individual income tax model do take into account this sudden spike that we've seen in Q3 due to the federal stimulus, which did include PPP loans. And those, mostly we follow the guidance of IHS in terms of how those flow to taxable income. A high percentage of that has flown into taxable income. There is a significant amount that is not taxable, but we have seen that has been a considerable dynamic for 2020. And when you see that corporate payments, corporate forecast is currently above the December 2019 forecast, a lot of that we do think is temporary and driven by this kind of temporary uptick due to the PPP loans.
Further questions? Thank you. Mr. Jackson, you have, go ahead.
Thank you, Mr. Chairman. We've passed out a surplus statement and combined statement, and and those documents should also be on our website now as well. I just wanted to spend a few minutes kind of walking through this handout and maybe just explain a few things. And I probably should have put it up on the overhead, but regardless, there's two sides to this document. One is the what we call the surplus statement. It says general fund surplus statement at the top. The other one is the combined statement. The surplus statement, the one that's a little bit easier to read font-wise, that one's meant to kind of show whether we're operating at a surplus or deficit, more or less, for the year. And the other document, or the other side, is more looks at the impact on the general fund and the combined balances. And again, that is the general fund and then the three savings accounts that make up the combined balances, the rainy day fund, the Medicaid reserve account, and then the tuition reserve account. Looking at that surplus statement, let me just kind of explain one concept that I refer to a lot, and that is this above the line versus below the line concept. And so you can see maybe a little bit more than 50% of the way down where it says annual surplus and deficit. It's kind of got two bold lines around that. And so what we try to reflect on this document is that everything above that line, that looks at current year expenses and revenues, usually recurring expenses, recurring revenues. And then the section below that, as it's labeled, other sources and uses of cash reserves, that is, those are one-time revenues coming in or one-time expenses. And so the big thing I want to kind of point out there, well, let me just keep going here. So a few updates to this document since the last time we put this out. I think the last time we issued a surplus statement was with closeout, so probably back in mid-July. So this document reflects the updated actual forecasted revenue for FY21, so that 16,837.4 that you see up towards the top in the FY21 column. The second thing I want to point out, and so again, just above the line in the middle there, you'll see the reversions that we're tracking for this fiscal year. It's a number of 303.2 million, and that matches with what I've previously shared with the committee staff and members, just in terms of we are holding 15% on agencies. We ask them to hold 15% of their appropriations back. As I mentioned on Monday, 15% on state agencies would have been approximately like a $665 million number. But as you can, clearly this number is a lot less than that. We're holding about 200 million on agencies, so we've worked with a lot of them to either reduce their target or maybe even eliminate their reversion target this year. And then also, back this summer, I brought a proposal to Budget Committee regarding holding a reserve on universities, on their operating. As you know, we're holding a 7%, holding back 7% of their operating appropriations, and that's worth about 100 million as well. The other thing I really want to draw your attention to is almost near the very bottom in the other sources and uses section. You can see the 885.1 million, and that goes back to the revenue presentation, just showing in that was money that should have come in last year, but with the deferral of tax day from last year essentially to early this fiscal year, we didn't think it was right to kind of show those revenues as kind of adding towards the surplus or deficit for this year. They're one time coming in this year, but should have been received last year. So that's the 885 at the bottom. The last two things I want to show or explain is just, well, I'll just say as you can see that we end this, right now we're forecasting that we would end this biennium just over 2.3 billion. And if you kind of compare that to where this document starts, the 2.27 at the very beginning there in FY20. So we're roughly right now expecting to be kind of back where we started. Again, that's based upon reversions that haven't happened yet and revenue that's not come in the door yet. But again, just a couple things I want to point out of things that aren't on this document, just because they're kind of unknowns at this time. As the footnote mentions at the bottom, this doesn't reflect the opportunity to reimburse the general fund from the coronavirus relief fund for potential potentially eligible public health and public safety payroll expenses. One, I mean, that number has not been completely determined yet, just in terms of what the eligibility is. And the decision hasn't been made as far as whether that should go back to the general fund to reimburse those expenses, whether it should be set aside to cover other COVID-related costs or vaccine distribution costs if the federal government perhaps extends their deadline but maybe doesn't provide more funding, or whether it goes to something like reimbursing the Unemployment Insurance Trust Fund. The other thing that this does not include, I think up next is the Medicaid forecast, and this does not include, you'll see in their presentation a potential to, they're forecasting that we will have, I think it's a number of about $300 million left over at the end of the year in Medicaid, but again, that's with 7 months to go in the year, and I'll also just note that I think in at least 2, maybe the 3 last biennia, we've not actually reverted that excess, but maybe used it to buy down some of the first year's appropriation in the new budget. So just wanted to mention that those weren't on there. But with that said, Dr. Brown, I'm happy to shut up or take any questions.
Questions for Mr. Jackson? Senator Faddy.
Thank you, Mr. Chair. Thank you for your presentation. Just want to confirm what I heard. So that footnote indicates that the balances do not reflect the CARES Act dollars that could potentially reimburse expenses for health or public safety issues, correct?
So there have been direct expenses that we've been reimbursing along the way.
Yes.
There has been confusion kind of this entire time about, there are provisions that allow us to presume that public health and public safety payroll costs have been predominantly used for managing and responding to the COVID virus. And those provisions have kind of, over time, the guidance that we've received from the federal government has, it's been a little bit challenging to kind of decide, okay, is this every public health and every public safety employee in the state, are we eligible for reimbursing those, or is it just the frontline responders, things like that? And so I think I think we've just now recently got maybe some clarification that we can kind of depend upon in terms of what those what are definitely eligible expenses, but we're not all the way through the year, so we'd be tracking all these eligible expenses essentially from when the pandemic started through December 30th this year. I think we have some estimates on what that might be, but it's not a definite number yet.
I appreciate it. I think and correct me if I'm mistaken, so I think from a flexibility perspective, for us to maintain a balanced budget and to maintain healthy reserves and continue to be fiscally responsible, I think the message that I take from this surplus statement is that there are many assumptions over the next 7 months, including changes in the economy and the forecast and so on. But assuming things hold true and we end up with a $2.3 billion in surplus, and we still have $700 million in the CARES Act dollars, and assuming that the federal government will act, I think I've heard this morning, I read that the Senate is, Senator McConnell indicated they will not leave Congress before acting on a spend or a stimulus package before the end of the year. The message that I take from this analysis is that we might have some flexibility in determining appropriate policies that could help our local economy. The word that I'm zooming on is the word flexibility, because I think all along we said our objective is to maintain a balanced budget, to be sure that we have enough healthy reserves, and then be able to be flexible and respond to emerging needs. Is that the message that is a reasonable understanding of these numbers?
I think that's a good way to state it, Senator, and I'll just say, later this morning, Chris Johnston, the OMB director, will be doing a CRF CARES Act presentation, and I think he can respond even more specifically.
I appreciate you. I personally look forward to working with our committee and with the House committee as well to be sure that we maintain these principles. I'm very supportive of us maintaining a balanced budget, maintaining healthy reserves and being flexible in terms of where we address all of these emerging needs next year. So I appreciate you and your team.
Thank you.
Thank you.
Thank you. Further questions for Mr. Jackson? Thank you.
Thanks.
Thank you. At this time, can we hook up Ms. Taylor and Mr. Damler for the Medicaid forecast? And we'll turn it over to them whenever.
Hi, Allison. Hi, Rob. Hi, Kathy.
Good morning, Sola.
Good morning, Rob. Can you hear me loud and clear?
Yes.
Can you see me?
Yes.
Do you see the members of the Budget Committee?
No. It is zoomed in on you at this time.
Okay. All right. Allison, can you hear me? Allison, good morning. Can you hear me? Is she on mute?
I don't see her joined yet.
Yeah, I don't see her either.
Okay. But we have Paul. Hey, Paul. Can you hear me? Hi, Paul. Good morning. Can you hear me?
I see you. I see the Senate chamber.
That's good. Can you hear me loud and clear, though?
Yes, I can.
Thank you. Mr. Chairman, I think we're ready, sir.
You have the floor. You may present.
Great. Thank you, Mr. Chairman. Confirming you can hear me okay?
Yes, we can hear you. So the
All
floor.
right. Good morning. Thank you for the opportunity to be here. I am Allison Taylor, the Director of the Office of Medicaid Policy and Planning, and I am presenting to you today the December 2020 Medicaid forecast. I have with me Rob Damler. He is our consulting actuary from Milliman. He's going to walk us through the forecast in a few moments, and we also have FSSA CFO Paul Bowling here with us, and our Medicaid actuary and Director of Reimbursement Kathy Leonard. The Secretary spoke with this group yesterday and laid out the context for this Medicaid forecast. Before I turn to Rob, I wanted to take just a minute to reflect and reinforce really just a few points that she made. First, I wanted to express my gratitude to be in this position, serving the Medicaid program, really when Hoosiers need us most. I can't believe that I have been here for almost 4 years. I had the opportunity to work with and build a team and processes that in hindsight, really put us in a position to not just weather the pandemic, but really become a critical actor in addressing the complex health and social issues that are facing our state. So the Secretary mentioned that we had learned so much and that we had changed a lot and that it would be a shame to go back. And I guess I just wanted to second that sentiment. Within Medicaid, we have focused on really swift communication with providers, rapid adjustment to policy as needed. We've placed a premium on reducing administrative barriers wherever possible, maintaining enhanced points of contact with stakeholders, and maximizing opportunities for greater access to services like leveraging telehealth and really focusing on community-based care. Our Medicaid team, although I think they're a bit tired like the rest of us, are incredibly energized though about the opportunity to be that powerful engine for good that the Secretary mentioned to you yesterday. So onto the forecast, the secretary mentioned that this is fully funded, formed under 4 principles. I want to just reinforce those really quick. Preserve member services, reduce administrative burden, build long-term efficiencies, and align and partner across agencies. I am personally really grateful that we could avoid new provider rate cuts in this proposed Medicaid forecast. Kathy and I in particular, have been working very closely with CFOs and Medicaid directors across the country, trying to kind of tackle our approach to the response to the pandemic. And lots of states aren't so lucky, so they are using that as a tool to balance budgets. I will also, though, reinforce what the secretary said yesterday, and that while we are avoiding rate cuts as proposed today, we are not increasing provider rates in this forecast. The rate methodology that we have been working on, that we've shared with you in prior meetings, has been paused as we recover from the pandemic, but we are excited and will return to that as soon as we can, maybe as early as the next biennium. And then just finally, just a couple of thoughts on the point of provider relief. I am really grateful that we were able to leverage CARES Act funding, coronavirus relief funds, and that providers actually had individual access directly to HHS for some federal funds to weather the pandemic. Fortunately, our Medicaid provider network has remained very stable during the pandemic. We've actually added to enrollment. We think this is maybe partly due to some of the streamlining enrollment that we've been offering, and we did add a new group of providers as well this year, behavioral health specialists. So it's I feel good that we were able to maintain that network. With that, I want to thank you again. I know the group here has an incredible task ahead this session. We are here to partner with you, and we really look forward to collaborating. I am going to hand it over now to Rob, and he'll walk you through the forecast. I guess I just want to mention one thing about it. This is based on the facts as we know it, which the PHE ends on January 20, 2021. We will present an updated forecast in April, and if there are any updates to the duration of that PHE, those figures will reflect that. So Rob, take it away. I think he's going to be sharing slides with you.
Good morning, everyone, and thank you, Allison. To introduce myself to the members of the committee, again, my name is Robert Damler. I'm a principal and consulting actuary located in the Indianapolis office of Milliman, and I'm also a member of the American Academy of Actuaries in presenting this information and qualified to present the information that I'm sharing with you today. I am going to share my screen. I believe that everyone there has a copy of this presentation, so please feel free to work through that as I do as well here on the screen. So again, this is our December Medicaid forecast. As previously mentioned, we are projecting through state fiscal year 2023, so through the next biennium. This is the first projection presented for the next biennium with regard to our Medicaid forecast. We have data and information included in this forecast through September 30th of 2020. So I'm not certain how well this is illustrated on a screen there in the Senate chambers, but if you can follow along in your presentation packet, the key here is the PHE is projected to end in January 2021, and all of the information that's presented here reflects that assumption. There are 2 key items that are impacted by the public health emergency. First of all, the maintenance of effort requirements are tied to the public health emergency. So under the maintenance of effort, individuals essentially are remaining on Medicaid. Historically, we have had about 35,000 individuals enroll and disenroll. So there's pluses and minuses coming on each and every month. Historically, prior to calendar year 2020, we have seen about 35,000 individuals moving on and off Medicaid each month. That has been significantly reduced to almost non-existent number of turnover of people leaving Medicaid through the maintenance of effort requirements. So those individuals are staying on Medicaid longer. So that's an increase in enrollment. The second thing that also is tied to the public health emergency is enhanced federal funding. The enhanced federal funding will continue through the end of the calendar quarter, that the public health emergency is declared. So in this situation, the additional funding from the federal government, which is approximately 6.2%, will go through the end of March, so March 31st. So those are kind of the two key components associated with the public health emergency. There are many other subcomponents, but at the larger level, that's where the impact of the public health emergency has on our Medicaid forecast. One quick note also on the enhanced federal funding, that does not apply to the newly eligible population. The expansion population under the ACA, or the newly eligible population, which is commonly referred to today, does not receive the additional 6.2%. We do continue to receive the higher federal match rate of 90% on the newly eligible. So therefore, the enhanced 6.2 does not apply to those populations. So as I have shared with you, the first three line items that are shared, the Healthy Indiana Plan, the Hoosier Care Connect, and the Hoosier HealthWise program, those are our three programs that are managed care programs. The Healthy Indiana Plan primarily has our parents and the newly eligible adult populations within the Healthy Indiana Plan, as well as pregnant women. Hoosier Care Connect are individuals that qualify under the disabled eligibility category under Medicaid, but are also not eligible for Medicare. So these are Medicaid only populations under Hoosier Care Connect. And then finally, Hoosier HealthWise, this is primarily our children population. Again, those three are our managed care populations. As you can see, for the Healthy Indiana Plan, Hoosier Care Connect and Hoosier HealthWise, moving from fiscal year 19 to fiscal year 20, we see significant increases or growth in those. Those are primarily driven by the enrollment rather than the cost per member. So we are seeing during fiscal year 20 and fiscal year 21, during the public health emergency and other actions with regard to use of healthcare services or lockdowns, we are seeing lower utilization of services for many populations. However, we are seeing fairly significant enrollment growth, which we'll look at a little bit further on in the presentation. We continue to see in the Healthy Indiana Plan, which is the newly eligible population, primarily in the adult population and parents, continued growth into 2021. Again, they are the ones that are primarily impacted by the COVID-19 economic situation, the maintenance of effort. Those situations really have impacted more so our adult population. So you can see a fairly large growth into 2021 for Healthy Indiana Plan. Lower growth expected for Hoosier Care Connect and Hoosier HealthWise. So that is really our managed care populations, fairly significant growth in these populations in both in the enrollment during fiscal year 20 and fiscal year 21. We also see growth in some of the other areas. I'm just going to work through line item by line item for fiscal year 20 and 21 and speak about those. Again, for fee-for-service, we do have members who are still fee-for-service. Those are primarily our dual eligible individuals. or individuals that are receiving home and community-based services or institutional care services. So again, we're seeing cost per unit decreases in these populations because we are seeing utilization decreases occurring in many of the fee-for-service programs, but we are having growth in the enrollment. So those continue to have the 8% and the 7% growth in the fee-for-service programs. In the institutional care, in the community care, those are primarily our nursing facilities and ICFID populations, as well as our aged, disabled, and other home and community-based waiver programs. In the nursing home population, we have seen a slight decrease during the COVID-19 pandemic of about 10% of the institutionalized nursing home population. However, we are seeing higher costs, both through emergency funding that was provided through the federal government, as well as increases in cost of care for these populations in both the institutional setting and the home and community-based setting. So it is a combination on the home and community-based setting that we do have more enrollment occurring on our waiver programs and not using the institutional care during the COVID pandemic. And we are also seeing higher cost per unit for many of those services. A few of the other line items that are here, Medicare buy-in and clawback. The buy-in program does receive, as well as the clawback does receive the enhanced federal funding. So there are some changes here. The reason we're seeing a slight decrease in this is that the clawback payment that is included in that line item is 100% state funded. It is tied to Medicare Part D program. And so because of our state funded, only amounts that are reflected there with the increased enhanced funding that has caused a slight decrease, and then a subsequent increase into 2022. Rebates and collections are primarily the pharmacy rebate program. Our prescription drug spending has remained relatively stable. Utilization has remained relatively stable during the COVID pandemic. So members are continuing to receive their pharmaceutical services. And so therefore, the rebates here you can see are relatively stable over the projection period. Finally, we do back out some of the CHIP programs because they're funded separately. And then we have other expenditures, which some of the changes that you'll note here are really tied to the DISH and UPL payments that are shown here and some of the fluctuations that are shown. So the values that are illustrated here are on a state and federal basis. To highlight some of the 2022 and 2023 changes, we are indicating here the public health emergency ending in January 2021. Then what we have done is made some gradations in our projections with regard to enrollment, returning to traditional usage levels of healthcare services. That will take several months to the end of fiscal year 21 and into early fiscal year 2022. But you can see, for example, under Healthy Indiana Plan, a decrease here because we do expect some of the enrollment to change once the maintenance of effort is eliminated. So again, moving from 2021 to 2022, you have some variances with regard to the percentage changes in our growth rates. And then finally, in fiscal year 2023, continued normalization of our projection assumptions. Moving into the federal funding of the program, which is the lower half of this program, of this illustration. Primarily federal funds have had a fairly significant increase in fiscal year 20 and fiscal year 21 due to the enhanced 6.2% funding on most of our Medicaid programs. Again, excluding the newly eligible. IGTs are impacted through some of these changes that are occurring, including the IGT base shift that's noted there in fiscal year 20 of $135 million. Half funding is changing with regard to half funding supports our hospital assessment fee funding. So those amounts are changing over time with growth in enrollment and growth in expenditures. And then HIP 2.0 funding, which primarily funds our newly eligible population. With some of the changes here, we are seeing impacted changes with regard to HIP 2.0 funding needs, and especially the higher enrollment growth into fiscal year 2021. We have shown at the lower section of this, the forecasted Medicaid General Fund assistance need in addition to the General Fund Medicaid assistance appropriation values. We are showing that we have had a shortfall or a surplus. We are showing surpluses of $249 million in fiscal year 20 and $336 million in fiscal year 21. We are also showing the additional federal funding down below that, just so you understand how would our budgets have been impacted without this additional federal funding. We did receive approximately $239 million of federal funding in fiscal year 20 and projected with the PHE ending in January to be at $373 million of additional federal funding over 9 months of funding. We have shown here as well what our growth rates are with our General Fund Medicaid assistance appropriation. If we were on a status quo, it is about a 4%. Obviously, with the removal of the enhanced federal funding in 21 to 22, we do show a 19% increase. However, in relation to our General Fund assistance appropriation in 2021, we are showing a 4.1% increased growth, and then a 4.6% increased growth in 2023. The next slide focuses on our CHIP program, and our CHIP program, as you may recall, under the Affordable Care Act, there were some enhanced funding that was made available up through 2019. That advanced funding was reduced over the next 2-year period. And so through that, that has greatly influenced our applicable FMAP rates or federal matching rates. So you can see in state fiscal year 19, we were receiving 99% federal match. In 20, we had 92.6% federal match. And in 21, we had 81% federal match. Starting in fiscal years 22 and 23, we will return to the standard FMAP rate without any additional fundings. And so that is the 76%. So historically, prior to the Affordable Care Act and some of the additional funding that occurred through that, historically, our federal match rate on the CHIP program has been at the 76%. What this does cause is a fairly significant increase on an appropriation need, growing from 16 million in 20 to 35 million in 21, and then just slightly over 50 million at 53 million and 52 million in 22 and 23. So one of the things to also take into consideration, what we're observing, because of the maintenance of effort, children are not moving between the Medicaid program and the CHIP program. And so that has influenced a little bit of our expenditures in fiscal year 20 and fiscal year 21. And so there are some changes occurring because of that. So you can see how moving from 21 to 22, our projected CHIP expenditures are increasing fairly significantly. And a lot of that is due to the maintenance of effort going away after the public health emergency ends. The next two slides focus on a comparison to the forecast that we provided to you in December of 2019, so 12 months ago. We're just focused on fiscal years 2020 and 2021. The first slide here is all on a state and federal basis, and then the next slide will look at just state share only expenditures. So we start with the December 2019 forecasted expenditures. The largest impact on a state and federal basis is new enrollment through maintenance of effort and other COVID-related impacts. It is a little bit difficult to measure everything directly. So this is our best estimate of the overall impact due to the maintenance of effort and other COVID-related impacts. So while it was $165 million in state fiscal year 20, we're projecting $1,551 million of additional expenditures on a state and federal basis in 2021. Again, this would increase if the public health emergency is extended beyond January of 2021. We had a nursing facility temporary rate increase as well, which was the emergency funding there of $28 million in fiscal year 20 and $55 million. The nursing facility other reimbursement variance is really just the variance between what we were projecting and what actual nursing home expenditures have increased. Actual nursing home expenditures are increasing at a higher rate than what we had projected a year ago. What we are observing in both the institutional setting as well as the home and community-based setting is that the cost of staff, the employment costs, the hourly rates have had some fairly significant increases on labor costs. So labor costs are definitely increasing, and that does flow through the nursing facility reimbursement rate. So we are seeing additional costs in the institutional care. We are seeing lower fee-for-service utilization, including the waiver services. The risk corridor is associated with the managed care program. We had established capitation rates or prepayment amounts to the managed care program, to the managed care plans at the beginning of the end of calendar year 19, the beginning of calendar year 20. Because of the COVID pandemic, they have had fairly reduced costs, mostly in the hospital outpatient and physician services during the summer months, April, May, June, July. During that time period, they had significantly suppressed costs. The state renegotiated their contract with the health plans to establish a risk corridor which would recapture a lot of those reduced costs back from the capitation rates, the prepaid rates that we were paying the plans, back to the state. Now those funds do get shared with the federal government, so these are state and federal amounts, and there will be a reconciliation period. So we're not going to collect those amounts fully until calendar year 21 and into fiscal year 22. So there are some interim reconciliations associated with this, but we are recovering that. So that is a fairly significant amount. There's some timing adjustments on the capitation amendments. These reflect past calendar years and when they're paid and in which fiscal year. So those are just adjustments there. There was an increase in the hospital assessment fee changes in August of 20. The Part D clawback, I mentioned that to you earlier, that because that's on a state-only share with the enhanced federal matching rate, we're able to save about $49 million this fiscal year. And then there's the nursing facility UPL and DISH, some changes in which fiscal year things are getting paid and how those amounts are calculated, et cetera. So you can see this was a walkthrough of both the state and federal amounts and the impact of the COVID pandemic on our budget. This is really looking at our state general fund comparison budget. and walking through these amounts. Again, the maintenance of effort has a more modest impact on the state general fund because most of our impact is on the newly eligible population, which has the 90% federal match. The nursing facility, other reimbursement variances, the increase in cost per unit, the non-relief funds, that has a state impact of about $8 million in fiscal year 20 as illustrated here. The lower fee-for-service utilization impacts on a state basis. Most of those are at the standard state and federal match rate. The risk corridor coming through, the capitation payment amendments as well. A lot of these amounts are on the traditional Medicaid impact. So you can see that the total changes associated with each of these items, with the primary funding item at the bottom, the FFCRA funding of $238 million in fiscal year 20 and $370 million in fiscal year 21, having the greatest impact on our state general fund budgets. So those were really focused on the expenditure components of this. The next two slides really focus on the eligibility. And as you can see here, the first section of this focuses on our, well, this slide in total focuses on our 3 managed care programs, broken into the Healthy Indiana Plan, the Hoosier Care Connect program, and then Hoosier HealthWise. As you can see from the top 2 lines, we've had fairly significant enrollment growth in these populations during the fiscal year 19 to 20, and then significantly greater growth into fiscal year 21. So again, most of these are through the maintenance of effort impact associated with that. You can also see down in the lower section under Hoosier HealthWise with our children population with the 16% growth into fiscal year 2021. And again, what we have seen is we've seen lower cost per member in the children population. So the children and the adults are having much lower cost per person, even though we're having much higher enrollment. So there is some offset there. The Hoosier Care Connect, the disabled population, we have had much lower increases in those populations, but their cost per member has also remained relatively stable, less impacted by the COVID pandemic. There were some impacts for that population, but obviously much less of an impact in that they have a much higher healthcare demand that is chronic and a continual healthcare demand versus some of the acute care needs that you may see in the Hoosier HealthWise and Healthy Indiana Plan populations. Again, in fiscal year 22 and in fiscal year 23, we are getting back to our historical growth rates, especially in fiscal year 23, going from 21 to 22 with removal of the maintenance of effort. We are anticipating a decrease in our enrollment numbers on an average monthly basis. And then modest increases into fiscal year 2023. And then finally, what we're showing here on this slide is just information with regard to our fee-for-service populations. And starting off with the institutionalized population, the first line item does reflect our nursing facility population. And as you can see, we are seeing some decreases in the enrollment into fiscal year 21, with having about 32,400 individuals in a nursing facility on any given month. That's our average enrollment. We are projecting that to start decreasing or increasing back up in fiscal year 22, and then leveling off a little bit in fiscal year 23. We have seen quite a bit of growth into our home and community-based waivers. This is primarily driven by our aged and disabled waiver, as members are not going into the nursing facility institutional care. they are receiving services on our aged and disabled population waivers. Many of the other populations are our fee-for-service populations, including our dual eligible, the Medicare savings programs, et cetera. So overall, we are seeing a fairly significant growth into 20. We had just overall about 3.9% growth, with a 16.3% growth into 21. We are projecting some decrease in enrollment for fiscal year 2022. That decrease may be impacted depending on when the maintenance of effort ends and the public health emergency ends. So again, with it ending in January, we are transitioning that down, that enrollment down into at the end of 21 and into 2022. Again, 2022 to 2023, relatively flat, which is our ultimate trend assumptions. So that comes to the end of my presentation, and I will open it for questions at this time.
Thank you, Rob. Back to you, Chairman.
Senator Brown.
Thank you. Appreciate that presentation. Getting back to page 4, with respect to the comparison to December 2019 Medicaid forecast, the line on lower fee-for-service utilization, including waiver. So this would be the lack of, with hospitals, outpatients closed and or those being reluctant to go and use those facilities. So we're not anticipating that going forward, that kind of reduction, correct?
Yes, that is correct. We saw fairly significant decreases in the emergency room, 30 to 40% decreases in emergency room usage as an example. We also saw fairly significant decreases even in the use of physician professional services and dental services. Dental services and for several months were down by close to 90% reduction in dental services. So
because
again,
they were closed, right?
Yes, that is correct. Dentist office, many of them closed during the original several months of the pandemic and decreased utilization. So we're bringing that, we're actually observing increases in those utilizations getting back to normal. If we start looking at September, October, November data, we're definitely seeing utilization getting back to normal. Not everything is 100% back to normal or pre-COVID pandemic levels, but we are definitely seeing it reapproaching, and that's what we're using in our projections.
Right, but now we've had some shutdowns, so we're going to see some drop again. And so I'm curious, when we see this, does anyone track the things that have been canceled? In other words, the utilization that would have taken place, whether it's a dental appointment, assuming this is all Medicaid, of course, only. We're not going to look at the bigger picture with this. I mean, that's not what you're looking at, but whether or not it's a dental appointment, an outpatient surgery, is anyone keeping track of that? And or is there a way to calculate when that patient, if you will, returns if they are seeking increased care because of delayed care? Is anyone projecting that in a forecast?
We are not currently doing that specifically. We are trying to build in some pent-up demand adjustments with our trend projections. And we are working with our managed care plans in negotiating our contracts for next year to make sure that the capitation rates reflect the estimated level of enrollment or utilization of services at this time. So again, we are working with the best knowledge that we have when we project that the public health emergency will end. We are bringing in, for example, immunizations into our projections and the costs associated with those. So we are bringing those items in, but with regard to how will delayed care impact future costs, we're not currently calculating that or estimating that.
So no one is keeping track, for example, until the most recent executive order, as an example, if certain procedures had been scheduled and are now canceled, which would have been on the books, so to speak, for Medicaid, and that's going to be pushed forward into 2021. No one is keeping track of that number to sort of keep an idea of what kind of increased utilization is going to occur in 2021.
Well, we are projecting into 2021, and we're looking at what we believe to be pent-up demand. Most of our costs are in our capitation rates or premium rates that we pay to the health plans. And so through our negotiated rates, we are trying to perform a best estimate of where we think utilization will be next year, which has an understanding of pent-up demand incorporated into that, which that pent-up demand is from delayed, individuals not receiving care this year, but receiving care next year.
Yeah, I think
Senator, I might note that we don't have a book of appointments and things that are upcoming, but certainly we do check in with providers regularly. So to your point, I know in the early months of the pandemic, we were, communicating with hospital associations and individual hospitals saying, hey, what are you seeing? What is your utilization? What level of appointments are you delaying? So that is a kind of a continuous feedback loop. I think to Rob's point, it's not precise or a science. We don't have a commanding knowledge of all of it, but it's an important, I think, feeder into Milliman to develop that forecast. Our health plans too, because of their relationship with providers, sometimes have more of a clear picture on what the immediate impact on appointment levels is. So that's a great question. I just wanted to provide some context that, there's informal ways for us to get a sense of those levels too.
All right, well, I'm going to push back a little bit. I don't think we should really be calling this just pent-up demand as if everyone's waiting in line to get the newest PlayStation. And the fact that you just stated that providers sometimes have a clearer picture, I couldn't agree more. So that's why I have this concern. So I'd like to see when we get the 2021 results, if you will, of this pent-up demand, I'd like to see the kind of utilization and to see if it's more significant and acute because of the delays, particularly now that we've done that yet again. So I'd like to be able to see that breakout. I don't know if that's going to be coming from you or which department, but I'll look forward to that. So I have one more quick question. With respect to, on the same page, the hospital assessment fee and the changes, is that because there was such low utilization that what did we do with that fee? Or is that because that's commensurate to the utilization, correct? Is that why there's nothing showing for 20 and there is for 21?
The hospital assessment fee is also impacted by the federal match rate. So as the federal match rate is changing, the hospital assessment fee would also change. It is also impacted by utilization of services, but it is impacted by the enhanced federal match.
Okay, thank you.
Mr. Jackson?
Thank you, Mr. Chairman. And good morning, Rob and Allison. Two questions for you. I noticed that the data is through September 2020, and just, since then it seems like there's been a lot more hospitalizations regarding COVID. And so I'm just curious, is there a chance that the projections are kind of undercounting our eventual COVID spend as this doesn't include October, November, December COVID hospitalizations?
Well, we are monitoring through working with the health plans. Most of our acute care utilization is through our managed care program. So we do collect what we refer to as encounter data. So we do see all of their claims that they're processing and paying. We are monitoring that. Yes, while this forecast values reflect data through September 30th, that's our, for lack of a better term, jumping off point. We are looking at encounter data every day, every week, every month. So we are up to date on the encounter data, but there is a lag in reporting that to not only our health plans that are contracted with, but also then to the state as well. So we are doing our best estimates and trying to understand that and build in what we're seeing. We have, we are trying to build that into the rates, but again, a lot of it is not complete with regard to claims being processed and things of that nature. So.
Okay, thanks. And one more question. And so, Rob, you mentioned kind of an assumption that the public health emergency would end in January as part of the main appropriation numbers page and everything there. And so my understanding is that the enhanced FMAP lasts through the quarter in which the end of the quarter for when the public health emergency declaration goes away. And so if you're right, and in terms of January 2021 is when the public health emergency ends, we'd continue to get the higher FMAP through March 31st. And so I guess the way I look at it is that the kind of revenue is maybe capped in a way, or definitely in place through the end of March. But what if the assumption as far as the public health emergency is off by a month or so, and so let's say it's not until February or until mid-March or so, and so you don't have that declining enrollment in there, would that, I guess, how much more expenses would we be talking about if the revenue isn't going to change all that much, but if the expenses continue because we don't have any type of reduction in enrollees for another month or two?
There is some definite impact if the maintenance of effort is pushed towards the end of the quarter. It is difficult to say. We are decreasing the enrollment over several months because for the state to collect the information and go through the entire process, it will take several months for individuals through notification requirements and things of that nature. So we do have some of that rolling built in. I would anticipate, and then how does that kind of impact June 30th? If we're just looking at state fiscal year 2021 as an example, or does this push more into 2022? So I don't have a clear number for you. We could follow up with that. I would anticipate that it may be on a state share basis, $8 million to $10 million per month. If the enhanced federal funding ends on March 31st and maintenance of effort is extended either one more month or 2 more months. Did that answer your question?
Yep, thank you.
Thank you. Further questions? Senator Melton.
Thank you, Mr. Chair. I'm not sure who this should be directed to. I'm not sure if Zach can answer it or not. With the surplus and the Medicaid assistance here, does this go back into the general fund or the Medicaid reserve fund? I was just a little clarity there.
Yeah, I would say there's probably maybe 3 options to discuss. One would be, and the first one is kind of, as I was mentioning earlier, at this point in the process of budget development, what's happened in I think 2 or maybe 3 of the last biennia, when we've got to that April, the new April Medicaid and revenue forecast, whatever that number is there, and so right now they're showing a 337 million or so number, whatever that fine-tuned number is come April, that's often been used to buy down the first year of the Medicaid appropriation, so it's neither reverted or anything, it's just held with FSSA, and we just subtract that amount from the 2.5 billion amount that they're requesting for next year. That's the most likely option, I would say, subject to how the General Assembly writes the bill, writes the budget bill, but other options would be reverting it back to the general fund or putting it in the Medicaid reserve account.
Further questions or comments? Thank you very much for your information. We're going to take a short recess here of about 5 to 10 minutes, so stretch, and we'll be back in about 10 minutes. Thank you, members. I think we'll come back to order. At this time, we'll have Chris Johnson come up and talk about CARES funding. The floor is yours, sir.
Good morning. I'm Chris Johnston from the Office of Management and Budget. Pleasure to be back with you this morning. What I would like to do is continue the updates that I've been providing at your meetings on the Coronavirus Relief Fund. Some of these slides will be repetitive, but I think with some of the questions that I heard that come up in previous segments, and to Zach, it might be helpful to talk about some of those. If you recall, the Coronavirus Relief Fund is a major fund, but it's just part of the overall CARES Act. A lot of people have talked about CARES Act funding, but I want to focus mostly on the CRF, or Coronavirus Relief Fund. And we've discussed before, but there's been a consistent, or the statutory guiding principles are laid out in these bullet points. Eligible uses are for necessary expenditures incurred due to the public health emergency, not accounted for in the most recently adopted budget, and it's for costs incurred between March 1st and December 30th. And revenue replacement is not a permissible use. And the program's been guided by the guidance from U.S. Treasury and the Office of Inspector General. One thing that, a couple of points, I guess, that we've talked about before, but I think it's important to discuss again. This is coming from guidance. One piece here is from the U.S. Treasury. The other is from the Office of Inspector General. And when we first received the funding, and we were starting to administer the funds, there was an expectation that the money, the actual expenditure from the fund, needed to leave our coffers by December 30th. After receiving feedback from various states and municipalities that are recipients of the CRF, the Treasury issued the guidance that you see up there in italics, which basically says the money does not have to be spent by December 30th, but it has to be used for costs that were incurred between March 1 and December 30th. Now, there is an expectation to spend the money timely once you've incurred those obligations, but then further discussion occurred with the Office of Inspector General, and they issued that second block of guidance that talked about there is a reconciliation process that will occur quarter by quarter all the way through September 30th of 2021, so that as programs have changed and evolved, that you're able to demonstrate that the costs were incurred through December 30th. Again, as we've managed the Coronavirus Relief Fund, the staff at the State Budget Agency, and I want to thank all of them, that they're all getting drawn into this at some point in time. We're managing the relationships, the programmatic relationships with Memorandum of Understanding. And you can see the list of agencies that are administering various programs. Part of the issue, I think, is the goal is to move swiftly and to get the money in the hands or in areas where it's needed. But when you're administering a grant program, it takes a while to actually get the program set up, establish the state's or the jurisdiction's own rules and guidelines. You might have grant agreements or other governing documents with the subrecipient of that money. And so that does take a lot of time and effort to set that up. And then there are certain agencies, and Zach talked about that a little bit, about the general fund or general direct expenses that are incurred by other agencies. And an example might be plexiglass at BMV, when customer-facing state hospitals. You're probably looking at the technology and the plexiglass here in this chamber is part of, or would be a good example as well. I've taken the different memorandum of understanding and tried to group them, the $2.4 billion, into various buckets. The public health response, the economic and business relief area, local government, community and individual assistance, the direct expense recovery, as I just mentioned, and then additional programming, which we'll spend some time discussing that. What I'd like to do is just take a couple of minutes. Some of this we've talked about before, but then just a recap of what has been going on with the agencies that are administering the programs. First being the Department of Health, which has really been on the front lines as far as testing, contact tracing, ordering supplies for those operations, standing up the sites, working with local health departments. You can see that there's 88 sites, over 120,000 tests were administered in November. And I had a little typo there. That shouldn't be contract tracing, it should be contact tracing. But that there were 1,100 tracers, and they're continuing to train that staff. Part of that public health response, we talked about IEDC standing up a PPE marketplace. Here's some just updated statistics on that. Pieces of PPE procured, vendors used, the deliveries, the schools receiving a couple of deliveries on PPE. I did get an update on the Department of Health, and I think the number of pieces that they've distributed is actually double this when you consider what's being delivered to nursing facilities. We talked before, I think last month, about the Department of Child Services providing provider grant assistance. They're working with their child care and child welfare services providers. That program is still, they're reviewing the applications and getting the grants in place. Family and Social Services Administration is administering many, many programs. You heard the gentleman from Milliman talk about the nursing facilities rate assistance. So that is one component. There are provider support grants in the home and community-based services, the adult day services, the disabled provider services. Another component is the safe recovery sites and working with the homeless and with proper segregation and safety services there. Operational costs and PPE for state-operated facilities or state hospitals. Moving on to the economic and business relief component of the relief fund. We've talked about the workforce cabinet, and they've received their allocation of $75 million. They're really using or leveraging existing grant programs, the Workforce Ready Grant and the Employer Training Grant Program. And you can see some statistics there of their activities. In the continuing in the economic and business relief area, this is one that we've tinkered with, the Small Business Restart Program. Now, this was originally set up to be complementary to the Paycheck Protection Program with the federal government, trying to find or identify the segments of the business community that weren't being served by the PPE. And, excuse me, you'll recall we had a very slow start to that. And we made some changes there. It started to pick up. I think it's now $5 to $7 million, but there's still a $30 million allocation. And in fact, we're going back, and IEDC is changing the guidelines again, and the eligibility requirement, paying for more eligible expenses, and hoping to expand that and get that money moving as well. Again, it's going to be for the same time period from March through December 30th as far as finding the eligibility, but they're changing those guidelines and doing a remarketing campaign to get that back out around the state. And then AG had the meat processing grants. There's 41 projects spread across the state of Indiana. Trigger happy on this thing here today. Sorry. The Indiana Finance Authority is administering the local government program. Again, this is one of those that I think Zach had mentioned how waiting on the guidance really helped out. They have now provided grants or reimbursements to over 400 participants in the state. If you recall, this was to counties and cities and towns. And I think at the last count, I'll be getting an update today, but last week, about 275 million of the 300 million has gone out. And so the accommodation for paying for payroll, the payroll expenses for public health and public safety has really helped with that program. The Housing and Community Development Authority administered the Rent Assistance Program. That program was originally a $40 million allocation. They've exhausted that, and they're working through their backlog, their waiting list, and that's estimated to be another $4 million of assistance, and so that's why that went from the $40 million to $44 million. The Indiana Destination Development Corporation, along with the Indiana Arts Commission, was providing grant assistance for a lot of the community events and organizations that have really been impacted because of the COVID-19, and that's impacted not only their events, but then also just attendance at their facilities. And so those grants, 477 grants have been extended. The direct expense recovery, this came up, I think, in the earlier segment of your meeting, where Mr. Jackson was asked about the potential for the general fund, seeing that. So this is, the main items are really payroll reimbursement of the state, public safety, and public health employees. A lot of health and safety measures, as I mentioned. BMV with customer facing is doing a lot of this sort of thing. And another example would be DOC, congregate settings, a lot of expenses of trying to operate in a safe environment. And so Department of Corrections has had some costs there. They've also obviously had medical expenses as well, and so it's a litany of different direct costs. Information technology has been a cost not only for remote working, but then also just reconfiguration of office spaces as well in order to ensure social distancing. This will be adjusted. Then these costs are still being accounted for. In fact, I got one this morning asking about now we're transitioning from the testing and tracing, and so the question was, well, vaccine logistics. I mean, how paying for the cost of getting the vaccines distributed, as well as then also the tracking, the technology of tracking the individuals that are receiving the immunizations as well. And so that's going to be a cost that at this stage we could probably cover between now and the end of the year, but until or if something happens with the federal assistance, our ability, again, because of that restriction of covering costs through December 30th, we'll cover as much as we can of that vaccine distribution, but we may have to look at alternatives. And in fact, I'll take the time here to talk about that. This may be something that we need to collectively work on. So let's do the scenario of there's no additional federal assistance, or it's delayed for an extended period of time. We still have contact tracing, testing, vaccine distribution, food banks, the nursing homes. There's quite a few of things that would still have to continue. The safe recovery sites for social distancing and safety of for homeless folks. So those would all continue, but through into 2021. And so this may be something that we have to come back and discuss with you all as far as if we use the money to reimburse the general fund, can we get that back out and redeployed to cover some of these costs if the federal legislation, there's no further federal legislation. And I'm not even talking about dollars. I'm really talking about the extension of the date so that we could use it beyond December 30th. So the remaining funds. I know Fred Payne was here on, I think, Monday with his, probably his budget presentation, but he probably gave you an overview of the Unemployment Insurance Trust Fund. And so I'm sure he walked through some of these statistics that the trust fund has spent $1.4 billion of state funds so far. We're now borrowing from the federal government. And so we've asked, I've asked Fred and his team to give us various scenarios of how does this play out. And so we've got a borrowing level today. You've got sort of a spend rate of additional borrowing in order to continue to making payments. And this one is really, talk about tough forecasting, is a tough one because you've got different players that are coming in. You've got state funds, you've got federal funds, and then different eligibility programs of how long do you participate in each program. And so what we are proposing and what we are planning to do is to use $400 million of the remaining CARES Act funds to deposit into the Unemployment Insurance Trust Fund. That would, based on those various scenarios, and we took a range of these, of severe scenarios, sort of the current pace, and then more of a positive scenario as far as claimants against the fund, and said, well, the next big contribution from the employers is late April. And so what would the borrowing amount be through April on average of these different scenarios? And so that's, we came up with roughly $400 million. Now, that's just trying to secure or retire the federal borrowing. The trust fund, when you talk to the folks at the Department of Labor, they think that Indiana should have anywhere from $1.2 billion to $1.4 billion or higher as just an ongoing balance. And so $400 million does retire. If the borrowing isn't that much, then we've made a little down payment towards that $1.2 or $1.4 billion. But that's what we're planning to do. The next big one that we're investigating here, I don't want to say we directed, but we really asked Homeland Security to help schools as far as getting FEMA reimbursement for reopening costs and safe operation costs, sanitizer, I mean, the whole shooting match for PPE. And the posture from FEMA has changed, and there's now a lot of differing messages. And in fact, they put a cutoff of covering expenses through September 15th. And now when I've asked for some information, they showed that, and there's probably several hundred school corporations that have started the process, have submitted their LPAs, local public assistance applications. I got a list of 68 determinations. 60 of them have been denied by FEMA. And so our plan all along was to go through this process and that the state, the relief fund, would cover the 25% match. But now I think we have to be more diligent and actually get our arms around what the situation is with FEMA. Are the cancel or denials going to continue? And then how do we address this for the school's direct costs for those particular needs? I don't have a dollar amount on that yet, but it could be substantial. but it probably is all over the place as far as small school corporations to large and complex school corporations. So we're trying to get a handle on that. And then finally, federal assistance. We talked about that. How does that change our whole approach to this? I mentioned one situation that we don't get any additional assistance. I think there's a course of action there. If we do get additional assistance, and the extension of the date, but if there is additional assistance, and there's been speculation or talk about additional PPP, the Paycheck Protection Program, additional money for schools, additional money for the public health departments for vaccinations. I'm afraid I may be back in front of you for several months if that's the case, because that's going to be a recalibration of how we think about a lot of these costs. And so that's really where the open, if there's an open item here, it's really, we've got uses for it, but it's what are the best uses in that case. And so we'll continue to work on that. And then finally, the future actions here is not only, I'll go to the last bullet, monitoring the federal legislation and then making adjustments based on that. We've already continued, or we started reconciling and closing some programs, but again, if things change with federal assistance, we may not close all the programs. And then the big one, I think, is the flexibility or being able to adjust or amend our approach based on that. The reporting, we still issue the same reports that we have been out on our own website, but a new reporting cycle has started with the federal government. And so we just submitted that this week. And it's basically a recap of, I guess if I wanted to describe it to you, I'd go back to the page that had the memorandum of understanding and all the different programs. It'll have projects. It'll list obligations to those projects. And then there'll be detail of grantees, contractors, and transfer payment recipients. And so let's use Howard County. So they got an allocation out of that $300 million program, local program through the IFA. And let's just say that the threshold's $50,000. So any entity that got a transfer payment over $50,000 in that program, you'll be able to follow it through this report. I think it's going to be available to the public by the end of the month. Then it'll be on a quarterly basis after that. So that's through September 30th. Because of the amount of participant entities, whether they're contractors, governmental entities, you name it, they allowed for an upload feature. And so that's what it took a little time for the federal grants portal to be ready to consume all of that data from the various states. And so that's why it was delayed a little bit. I think we were supposed to be operational in September. It just went this week. And it was through September 30th. And then it'll be on the quarterly basis going forward. So we will have our report through December 30th filed, I think, January 10th or January 11th. The federal government reviews it, and then it gets posted out on the Pandemic Response Advisory Committee, I think. PRAC is the name of it. So, Mr. Chairman, I've gone on long enough. I'll entertain questions.
Thank you, Chris. Thank you for your hard work. Questions for Mr. Johnson? Representative Hamilton.
I can try to repeat it if you.
Thank you, Senator Brown. Chris, thank you for your presentation. And I just want to note that, all of our agencies have been working so hard, especially this year because of COVID, so much extra new work, and yours may be very near the top of that list. So thank you.
Thank you.
To you and your staff. You've heard me ask before, and I'm going to ask again
Okay.
about the rental assistance piece in particular. I continue to be very concerned about the number of Hoosier families who just a few months ago, parents were working families, low-income working families, and through no fault of their own, are facing eviction during this winter. We know that numbers, they're staggering. There's a statistic here, the estimated shortfall in rent by January statewide is between 152 million and 284 million. So, when we think about both the families displaced and their children facing that trauma, at a minimum 40,000, likely double that or more in the next couple of months. And then that impact of the 152 million, again, minimum, trickling through our economy in a negative way. Landlords who may rely on that rent for their own rent and food and family support. This is a piece that I just don't feel we've addressed very well with, in light of how much money came from the federal government to us and how much remains. Spending $44 million so far is seemingly a drop in the bucket in the number of families we've served. And we can do more. When I think about this issue, I think most about the children of those families. Trauma has a long-term impact on children, on all of us, but especially on our children. And the cost to society of that trauma are paid by society over time. Those children, they're going to school in their apartment today. Where are they going to go to school next week when they're evicted? Maybe their aunt, if they're lucky to have a couch to surf on, maybe their aunt doesn't have Wi-Fi. Maybe they're in a shelter. Hopefully they're not in a tent. We know there are tent villages cropping up. So I want to hone in on that issue in particular and lift it up and hope that we can, in the time we have left and the resources we have, and certainly with this relatively rosy fiscal outlook we see now today,
Okay.
what can we do for those families and try to reduce that divide that's grown so much between the haves and have-nots in our state?
Well, I can speak to the program that the Housing Authority is administering, and I believe they're going to work through their entire wait list of people who have submitted. I mean, so that's where we've authorized them to just continue fulfilling the grants or the applications on that. Now, the handcuff for the relief fund, I'm not saying there isn't a problem, but the use of the relief fund is only for the expenses through December 30th. And so that's where, some of the drafts, or I shouldn't call them drafts, reports on federal legislation does include, a rental assistance program. And I know that the Housing Authority is administering another rent assistance program through HUD. I'm not sure of what the dollar amount is. We've also checked in with the Township Association, as far as housing assistance there. And the reports that we're getting back are that generally the renters are working out payment plans with their landlords. And so there has not been a significant request through at least the trustee association yet. But I'm not, again, I don't want to sound argumentative. It's just that I do think there's many milestones or deadlines that are coming up at the end of the year, and the eviction is one of them.
Thank you. And I have heard from one of the service providers of the eviction papers in Marion County just last week that they're starting to see more and more. It was relatively slow, and they're starting to see it, and they're expecting a significant influx in January. So I just thank you for your response, and whatever we can do. If we are going to instead be able to revert some of these dollars to the general fund, as you said, I hope we will consider lifting them up to help these families stay in their homes.
Okay. Senator Brown.
Thank you, Mr. Chairman. Thank you, Director. So with respect to the program realignments and school reopenings, and I may be confusing the funds, but I know schools receive direct payments in the spring. Some in my community did not spend them immediately, anticipating or not knowing what they needed to spend in the future, in the fall, when they, if and when they reopened, and what that would look like. So when you talk about the FEMA denials and what we're gonna do with that, and even with the determinations in their favor, we still have a match. Is there any contemplation to those schools who have spent that money ahead of time or have saved it? I guess my concern is the more conservative, if they've sort of waited and didn't have the same expenses, and others that spent it early on, not anticipating the fall.
So I think you're asking the right question of what we're trying to wrap our heads around is each school's going to have their situation, and not only their fiscal situation, but their differing needs. And the thing about at least the starting point with FEMA. So I think we'll have at least a grasp of what they've submitted as their costs, because they've already put that information into the Homeland Security and FEMA portal. And so I think that's going to be, again, the basis for which we start looking at how big the need really is.
Okay, thank you. And then I've asked this question yesterday, getting back to the unemployment insurance fund. We know there has been widespread fraud. A lot of the sort of restrictions were taken off, and we needed to roll out the money right away. I understand that, but I'm not talking about individuals. I'm talking about organizations, and we know that from Russia and China. So has anyone done an audit at all to date on a month basis or on a company basis? ABC company has 100 employees, 100 people applied, for example, for unemployment, and ABC company says, I didn't lay anybody off. So I didn't let anybody go, so no one should have applied. Whatever the case is. I understand yesterday from Commissioner Payne that he didn't want to ballpark it and estimate, and I appreciate not wanting to speculate, but surely someone has been doing some kind of a preliminary audit or analysis.
I can't speak to that. I'm not aware of their procedures. I assume that there are either random spot checks, similar to, I used to be an internal auditor, and so you take a sampling and check those things. I don't know what their procedures are at DWD or the requirements from the federal government. I do know what Mr. Payne probably explained is that some of the checks and balances, as far as the applications when they come in, were lessened probably in order to get the money out to the claimants. But I can't speak to what their audit procedures or test procedures would be.
Okay, well, I asked a month ago, I asked yesterday, and I'm asking you. So I would really like someone to give me some sense of where they think we are. Thank you.
Further questions? Senator Melton?
Thank you for your presentation today. Just had a couple of follow-up questions in terms of when you broke down the $700 million that was remaining. You said $400 million will go potentially into the unemployment insurance, but I wasn't clear in terms of how the other $300 million was going to be potentially appropriated. So that's the first question, and clarity on the FEMA reimbursement piece in terms of how does that work in cooperation with the CRF?
Okay. So the first one is there's not a dollar amount there yet because we have not sized up what the potential applications could be from the schools. And I do think that could be a reasonably sizable number. And so then that would be the rest of it. And then the other would be pivoting whatever's left based on federal legislation. If we can augment, small business programs or other programs, have the ability to do that. That's what we would do to cover those costs in 2020. Now, as far as the relationship between the relief fund and FEMA, Because of the denials, we're actually looking at, once the denial's in place, I mean, then that relationship with the applicant or the school corporation would end, and we would pick it up from there as far as, so it would either be Homeland Security or the Department of Education would be the active state agency that would then, work with the school corporation.
Gotcha. I want to go back to a comment the representative was making in terms of kind of the crisis around housing and evictions and things like that. You made a comment about the trustees. The one thing I would just keep in mind about the trustees, a lot of folks are not aware where to go and get help. Okay. So if you're not hearing or seeing a demand from trustees, I think that's probably one indicator or source to consider. So I just want to, keep that in mind, that if you're not seeing a demand or a demand request for funding or assistance, a lot of folks don't know to go to the trustee's office because they've probably never been in these positions before to seek assistance, or there may not be agencies in their communities to help navigate them through their process. So just I wanted to kind of share that. Lastly, if it's possible to get a breakdown, I'm not sure if other members of the committee will want it, but the local governments, if there are some in our districts that have applied for the local government assistance through the CRF, that'd be great to know.
That one, if I don't want to, I'm happy to do it. Mm-hmm. There's a weekly list that's updated on the Indiana Finance Authority website of all their disbursements out to local governments.
Does it show
from that $300 million local program.
Does it show who has applied, or does it show who has been awarded?
Well, right now, I think if they're at 275 million, well, let me go back. I mentioned that there were, I think in the slide, 400 entities have participated. Mm-hmm. There's a potential of probably 600 entities between counties and then the municipalities in the state. And so the IFA and the AIC, and Association of Counties, have been contacting those that have not drawn down the money yet. Some of them just intentionally said, I'm going to sort of settle my books at the end of the year and do those reimbursements. And so there's both a list of the entities that with their allocations, and then there's a list of those entities with the dollar amounts that they've received thus far.
Gotcha. And similar thing with the supplemental support for the PPP. I believe that the governor had partnered with the Indiana Black Expo to provide some dollars for minority businesses across the state. I would love to get that information as well to see who received that support.
Yep.
Thank you.
Further questions? Senator Faddy.
Thank you, Mr. Chair. Chris, thank you. I just want to start first by thanking you and the budget team. I've been in your shoes before on a smaller scale, so I understand how difficult it is to be responsible for finances, especially during difficult times. So thank you for your public service and for helping us through this crisis. From the forecast earlier this morning, there were two indicators that seemed to be critical or red flags for us to pay attention to. The first was consumer spending. The second one was potentially in Q1 2021, the rental assistance, mortgage payments, credit card payments, which could have subsequent effects on landlords, small businesses, and so on. What are your thoughts or OMB's thoughts in terms of budget priorities as it relates to responding to those two specific points that were mentioned in the forecast? Meaning, will the budget reflect any priorities to address these two issues?
As far as consumer spending goes?
Yes.
Okay. Well, it's as far as priorities go, I mean, it's obviously a big component of the budget because of sales tax being over, I think the statistic was over 50% of our revenues. It's something that I've been watching, and actually again, not to get all geeky and wonky between the two of us here, But if you look at what has happened since April and May, consumer spending in April took a 12 to 15% dive. The same month, personal income went up by 12 to 15% because of all the federal assistance that went out. And then you actually see the effect of that spending. A lot of it dropped to personal savings as well. But as we recall, in Indiana, we tax goods. Now, 2/3 of consumer spending is actually services. But people aren't going to ball games, the restaurants, their taverns, whatever, on service and spending money on services. So they're spending money on goods. And so that has really, I think, has positively impacted our revenues. And I think the question is, because what I've been watching now is that personal savings is starting to get spent down. Now, it's still higher, personal savings is still higher than pre-pandemic levels, but it is getting spent down. So I think it has to be coupled with any additional federal assistance, the UI discussion, because I think the econometric firm said they were thinking about 3 months of extended and having a 5-month impact. Well, those are the things that I think we're monitoring as to, and I think we'll see again in April when they do an update of what that is.
Excellent. My final question/comment is that it seems I'm cautiously optimistic about this morning's forecast. I think we make assumptions in forecasts, and there are the pessimistic and the optimistic scenarios of those. And it seems that if the feds act on a stimulus package in the next couple of weeks, and looking at where the reserves are or the the surplus account is, looking at where revenues are expected to be at, I've asked Zach earlier, and it seems that the word that I was looking for is flexibility of spending, which I appreciate you maintaining that flexibility to be responsive to what will happen next year. My final question on that is, we've heard over the last few months about critical spending areas and I was extremely encouraged by our President Pro Tem and the Speaker of the House talking about, for example, protecting our schools during these difficult times. The teacher pay report just came out. The rental assistance conversation that we just had, I received several letters from my district where actually landlords are sending us letters saying, my tenants are not able to pay. I'm not talking about big corporate landlords. I'm talking about small landlords who have one unit and they use that income to pay actually their mortgage. So my point is that will you be supportive of priorities, including investing in our schools and in programs that are fiscally responsible, that does not violate the balanced budget, does not violate depleting fund balances or the reserve, that will continue to help our school system and our citizens stay in place, meaning that they're not evicted and so on?
Well, I think obviously tuition support, education, Medicaid, public safety are all critical services that I think collectively we think are our priorities. The concern I have is what happens in years 2, 3, 4, and 5. And being able to, once we make that policy decision, are we able to continue funding those priorities? And so being able to live up to those established policy priorities. I think in your previous background, I'll use the COPS grant, right? Federal government gives you a bunch of money to go hire police officers, and they say, well, it's good for 2 years, but you have to continue hiring those 10 police officers for 5 more years.
Absolutely.
Right? So we want to avoid those situations.
I appreciate you. I thank you again on your staff for working on this, and I look forward to working with you on innovative solutions that can manage all of these unknowns in a fiscally responsible way. Appreciate you. Thank you.
I'm a constituent, so.
You're my boss. I appreciate you.
Senator Mishler.
Thank you, Mr. Chairman. Chris, so I'm a little confused. So, and you probably can't really answer this. I don't know, but so during this, I have a lot of people at home telling me that they were making more money on unemployment. So if you're making more money on unemployment, how can you then not pay your rent? So I'm confused on the rental assistance piece when they're telling me these people made more money, but yet they didn't pay their rent. So did they use the money? Is that why our goods are so high? Because they used the money to buy goods and didn't pay their rent? Is that kind of an indication?
Senator, you're setting me up here, but that could be a possibility. But here's the other anecdotes, and this is purely anecdotal, from landlords that said that are not corporate landlords, but they see their tenants that are going to work in the morning and said, I know there's a moratorium and I'm working and I know I don't have to pay, so I'm not going to pay until I have to. And so I think it's a combination of things that are out there. There's some people that have truly been laid off and can't make their payments. There's no doubt about it. But there's others that are making their own personal decisions.
So in other words, we might have created bad behavior because by the moratorium, it's like, well, I don't have to pay it this month. I don't have to pay it till later. So I'll go out and buy a new TV or whatever, buy the goods, and then it catches up to them and like, oh my gosh, I got to go back and pay all that rent and I've spent all the money. It's just the numbers kind of show that almost.
I do think that's a concern, that when you have several months that you've gone by and then all of a sudden a big bill will come due. That may be playing out here right now. Yeah.
Thank you very much. Thank you for the information. We'll proceed to the the business part of the Budget Committee. We have an agenda that's been distributed to members of the committee and laying on your desk. Are there any addition or subtractions to the agenda? Hearing none or seeing none, the agenda is placed on the table at this time. You also have the minutes from the October meeting on your desk. I hope you've had a chance to look at those. Any additions or corrections to the minutes? Can I have a motion to approve the minute?
So moved.
Second.
It's been moved and seconded and approved the minutes. All those in favor say aye. Aye. Opposed, same sign. The minutes are approved. Next, we'll start to get into the projects that are on our agenda. And the first agency project is the Indiana School for the Deaf. Mr. Hawk may come forward. Thank you.
Thank you, Mr. Chairman, members of the committee. My name is Jeremy Hawk, and I'm here representing the Indiana School for the Deaf. We have two projects before you this morning. The first being a $760,000 request for a new HVAC system for buildings 1 and 2 on our campus, which we refer to as Rainey Hall. The current system is 20+ years old and rapidly declining. We're making constant repairs to the units as well as the components of that system. In addition to the state of the system, when it was originally installed, for some reason there was not a component for outside air to be introduced to the system. Due to this restraint, we are not able to control the humidity by introducing new fresh air to the system. So we do see mildew and lack of control of the humidity in those buildings. So this system would completely upgrade our components. We would replace the units, the large chiller on the building that would handle the system, as well as upgrade from pneumatic air controls to digital. Those upgrades should run this system for another 25 to 30 years. That is the crux of that project, so I'd be happy to answer any questions.
Any questions, Senator Brown?
Thank you very much, Mr. Chairman. Thank you. I'm curious, does the rent that the ISDH pay, I assume that's for the Center for the Hard of Hearing?
Yes.
And Vincennes, does the rent reflect the cost of this?
It doesn't. It's more of a partnership than really a rent agreement. We do receive some funds from them, but it probably doesn't cover all of what we provide in as far as maintenance and upkeep of those buildings. Our janitorial contract does clean their buildings for them. But at the same time, we utilize their ASL program for our own students. And in effect, they provide us with a workforce of ASL teachers and staff that eventually do come back and help benefit the school.
Both the Center for Hard of Hearing and Vincennes, or just Vincennes?
I was speaking specifically about Vincennes there.
Right, but that is something that they also need to complete their education, right?
Yes.
Okay, and then for the Center for the Hard of Hearing?
I believe whenever those services were removed from ISD, the appropriate budget transfers were made at that time. When the decision was made that they would be housed on our campus. So the appropriate funds to run the program were allocated to the health department, but ISD did retain the money needed to maintain those facilities because ultimately they did remain on our campus.
Okay, thank you.
Mr. Jackson.
Thank you, Mr. Chairman. Jeremy, just two questions, and one doesn't necessarily even apply to the projects here, but is the school largely been in session or virtual this semester?
It's been a hybrid. I would say right now we're probably working 60-40, 60 being in person.
And I'm sorry, I not so much the staff, but classes.
But yes,
Yeah.
so that was referring to students.
Okay.
This school year, we did start on a delayed schedule. So we pushed that back, I believe, a week or two. So we started the first weekend in September. We were in person up until earlier this month. But our staff has remained on campus the entire time.
Then secondly, just are you going to attribute any type of operational savings to this new HVAC system, any lower utility costs or anything like that?
Yeah, there will be, especially on the preventive maintenance side. We do spend an unquantifiable amount, but we do spend time and energy replacing parts, making repairs to the system. These two buildings were part of our most recent window upgrade project, so they do have brand new windows, which will be much more efficient as well. So that combined with this new system should provide some operational savings.
Further questions? Thank you. Next project, Mr. Hawk.
Okay, the next project on campus is a request for a little over $834,000 for roof replacement for what was formerly called Alumni Hall when this project was originally submitted. It has now been renamed to Willard Hall. The roof covers approximately 34,000 square feet, is roughly 25 years old, is in desperate need of repair. We've had a number of small leaks and water infiltration into the buildings for several years. Over the past few years, we've had one major incident in which the auditorium, which is housed on the second and third floors of our building directly beneath the roof, have received a lot of water infiltration and severely damaged the interior ceiling of that room. So we've made small repairs during that time. Our maintenance staff was able to patch the biggest issue that we've had, but we do feel that this is the end of the life of the current roofing system and that a new one is needed at this time.
Questions? Thank you very much. Thank you. Next, we'll have Mr. Bacon. You want to go over to the other microphones?
Good afternoon. Aaron Bacon here with the Indiana War Memorial Commission. I'm here today asking for $1.39 million in order to begin work on the life and safety upgrades for the Indiana War Memorial Building. This money would include the complete design phase for a 3-phase project, including the programming and schematic phases for phases 2 and 3, of this three-phase project. Would also include the construction phase for phase one. Phase one would include providing emergency signage, installing new fire detection system, alarms, and relocating exhibits in order to accommodate these updates. It would also reactivate exits for ingress and egress in case of an emergency. Phases 2 and 3 would include a fire suppression system and construction for additional exits around the building in order to get back to fire code. Questions regarding these?
Any questions regarding Senator Brown?
Thank you, Mr. Chairman. Thank you. What do you anticipate, or what phases 2 and 3 will cost?
Phases 2 and 3. Phase 2 is proposed at $876,000. Phase 3, $2.827 million.
So the whole thing is about $5 million.
Yes, ma'am.
Thanks.
Any further questions? Thank you very much.
Thank you.
Next, we have Mr. Michael Smith, Department of Natural Resources.
Good afternoon, everyone. DNR has one project on today's agenda. That is the Redbird State Recreation Area Administrative Building for approximately $1.2 million. DNR is requesting approval for the construction of an administrative building and gatehouse at Redbird State Recreation Area located near Linton, Indiana, in Greene County. This property is one of two off-road vehicle properties in southwest Indiana. The other one is called Interlake State Recreation Area, located in Warwick County, about 30 miles east of Evansville. These two properties sit on old coal mines that closed prior to the Reclamation Act of 1977. Currently, Redbird has an 80 square foot gatehouse that has inadequate heating and cooling features. The 2,300 square foot admin building will serve as the main office to the property as well as the gatehouse. Currently, the service garage building serves as the administrative office. Since the service building is not located at the property entrance, this inaccessibility makes it difficult for our visitors to ask questions or receive directions from property staff. Due to the fact that Redbird is a former unreclaimed coal mine, approximately $200,000 of the total cost of construction will be earthwork needed to stabilize the soil. The two off-road vehicle properties are supported by revenue collected for off-road vehicle registrations and trail use fees that generate close to $1 million annually.
Any questions for Mr. Smith? Thank you very much.
Thank you.
Thank you. Next, we have Indiana Economic Development Corporation, Mr. Sellinger, and want to use this side, please, the podium. Thank you.
Good afternoon, everyone. My name is Jim Schellinger. I serve you as your Secretary of Commerce, CEO of the IDC and the Indiana Department of Defense Development. I want to thank all of you, first of all, for your service, especially during these times. We have a lot of challenges, and I get to be the voice of business all around the state of Indiana. And while we have, obviously, many, many challenges, we have many, many, many things to be grateful for. And it's because of the people in this room, the governor's administration, your colleagues in the General Assembly. I want to thank Senator Mishler, was heavily involved in this transformational deal, and I appreciate all that work. We're here to talk about two things today, covering the site cost and how to deal with that, which we're asking for a transfer of the next level travel dollars. And then secondly, and it may be, Mr. Chairman, a separate item on the agenda that I may have to get back up for, which is fine, which is talking about the Edge for Retention jobs that we're doing. It's been a busy, busy time at IDC, I can assure you, and something that you all should be very, very proud of. You probably don't get to hear this a lot because you're dealing with a lot of tough stuff every single day. But the state of Indiana is doing an exceptional job. We have record-setting years the last 4 years with economic development in our state, which means people that are losing their jobs, where their jobs are going to not come back, and we know there's some of those. We don't like to talk about it, but we know there's some of them. We're going to have jobs for them. So this year to date, we've had 265 projects, yet a fourth record-breaking year in a row. We just yesterday hit 31,145 job commitments, which breaks the previous record of 31,112. We'll close out the end of this week, so we'll have several more in there. Strongest pipeline I can remember my years at IDC going into 2021. 1.8 billion in payroll generation, which is an all-time state record for us. 5.6 billion in CapEx. The previous record was last year, 8.444 billion, but we had a couple biggies in there. 28.10 is our average wage. Last year, the record was set at 28.60 per hour versus the state average wage of 22.50, around somewhere in there. And this year, we've done work in 55 counties. And since 2017, we've had 1,172 projects that have represented over 118,500 jobs. The previous record was 93,000. 1.6 billion was the CapEx, previous 5.6 billion over 3 years. 28 billion in CapEx. The previous one I said was payroll. 28 billion in CapEx. Huge investments in our state. That means jobs too. 2860 on the wages in 84 counties. So congratulations. None of that happens without you and your colleagues in the General Assembly. And I get the privilege of having worked in the private sector for 32 years, not having written one sentence of our story. I get to go talk about that around the world. Elanco came to us, second largest animal health company in the world. They actually came to us a while back and talked about the acquisition of Bayer. It was not even in progress yet, but we talked about that. And they now are the second largest animal health company in the world. In the process of in the beginning, I want to back up on the site. In the beginning, this site has always been an amazing site. Some people refer to it as the best site in the Midwest. I think it's the best site in the nation. I'm yet to be shown that kind of acreage, 91 acres, in the heart of a metropolitan area like Indianapolis, depending on who you talk to, the 12th or the 14th largest city in the country. I've yet to see a site like this and an opportunity like this. So we start talking in 2018 about this site. I've thought about for many, many years of what it could do in terms of transformational to the city. As many of you will recall, we had a lot of negotiations on this site back in the day that Infosys was coming here from India. And they located here first over in the One America building. They subsequently decided to build a campus similar to Mysore and Bangalore out of the airport. Well, we tried to get this site. And at that point, we walked away, or the developer attorney walked away from 7 handshake deals. Now, I've lived in Indiana 60 years. I spent my whole life here. I'm 60 years old, never left the state. And when you shake a hand in Indiana, that's a deal. I always say, if you blink your eye, it's a deal. Walked away from those. They wanted $40 million for the site, which I thought at that point in time where nothing had been done on the site versus when we made the deal, I thought it was outrageous and irresponsible. And so we obviously backed off. The rest of that story is a success story using the old airport site. And there'll be 3,000 jobs out there. But we occasionally have these projects like this that are transformational that come our way. Dow DuPont, when DuPont bought Dow, it was a new business. Out of that came Corteva, and they actually did a new federal ID number, so it was easy to treat them as a new business. But we weren't even on the radar screen. We were going dark as Ed Breen put it. We were going dark, and we reinvented our proposal, and they're here today. We're one of 2 global headquarters on the middle of Michigan. U.S. Steel, longest, they've been in business over 100 years in Indiana. They've closed before their Alabama operation, their Pittsburgh operation, their Michigan operation. They came to us for really what was a pretty modest incentive for retention for their jobs, which we don't do. We just don't do retention because if we did, every single company in the state of Indiana would line up and tell us they're leaving our state. So while we can do it by statute, we're extremely select in retention. But with the retooling of that plant, in an investment of $750 million up in Burns Harbor, we retain those 4,600 jobs for the next 50 years. So for that, we did Edge, a portion, really small on the dollar. We did $10 million based on Indiana employees only, not Michigan and not Illinois. Electric Works, you know, that was an incredible opportunity up in Fort Wayne, as you all know. We gave them a $50 million Dino credit. That has nothing to do with jobs. People can come back with job incentives, but it's a transformational project in Northeast Indiana who's been on fire and who I think is the symbol of regionalism. We talk about that all the time. And in Bottle Works, right here down the street, all of you know, we gave them $65 million. Again, a transformational project in a site that's never been developed. And we've got several more of those around the state of Indiana that I hope someday I'm up in front of you to talk about. When we first started talking about this site, it was before Elanco ever came our way. And at that time, the developer, as you know, publicly and privately said, this site is a $1.5 billion opportunity. Anybody wants to talk to me, it's a $1.5 billion opportunity. And said, if this, if that, if this, if that. I mean, but the ifs never happened. They never happened. So at that point then, I was actually in Mumbai. We had done and the governor joined me there. We had been doing working in Asian, and we tripled our foreign direct investment, by the way, in the last 3 years. And I ran into the developer on October 5th at the Pacers game, who was there as a part of the All-Star delegation. And I just teasingly, I've known for a long time, I said, wow, we give you more than you're going to get for eminent domain for that site, because there's a big lawsuit, right, generating. It's really bad, ugly. And so afterwards, about 3 weeks later, called me, wanted to talk about it. I was thinking, you know, 10 million, 15 million. So the developer came to me and said, I'd love to talk to you about this. I'd love to have you guys do this project, but it's going to be $100 million. And that's non-negotiable. Well, that doesn't work for us. That's worse than 40. So we had lots of talks, walked away from the deal several times, but saw this as a way that the state could figure this out, this ugly situation on the best piece of land, economic development-wise, in the country, again, in my opinion. That would extend the city from the east to the west. It developed the East Bank as a state park, and down the road developed the West Bank on the east side as a state park and bridged those two. So we saw it as an incredible opportunity. We know and acknowledge the developer paid $3 million for this site when they bought it from the Razor Trust. But we also know and have verified the work that's been done to help with the environmental. So the developer has in it about $9 million. Still not 25.5, it's about $9 million. But then got settled on $55.5 million, and that was it. There would be no more negotiations because the developer had an appraisal for that and said, I have an appraisal. You have to pay at least the appraised amount. I have a little experience in this. It's actually something I'm qualified to talk about, having been an architect for 32 years in the private sector. So I believe firmly we'd get a $25 million appraisal out of this, which we got $24.9 million was our appraisal. So we offered them 25.5. It wasn't working. On Memorial Day weekend last year, basically we couldn't come to terms on LOI. Long story short is I made them an offer and a purchase agreement, 25.5. They had a day to review it as is. And I wanted to point out at that point in time, Mr. Chairman, we intended to pay them $7.5 million in a down payment, a $6 million payment by the end of this calendar year, $6 million by the end of 2021, and $6 million by the end of 22. Since then, based on some creative thinking of some people in leadership, there's been the talk about doing the $20 million out of the Next Level Flights program. I've been asked a number of times why. I was set up for transportation, and I know this very well because I negotiated the Paris flight. I was this close to announcing a London flight. I was really well on our way to announcing with Japan Airlines a flight to Asia, to Tokyo, and we had flights in the work to Mexico City. We have ones to Toronto, but more to Toronto and Frankfurt. So we wanted this money. We need this money. But in terms of why would we propose that now when that's so important to our connectivity around the world, and I can't tell you how important that is and how successful the Paris flight was, there's 5 letters and 2 numbers is why. COVID-19. We have no flights that we're going to negotiate in the foreseeable future. It's not going to happen. And right now, the Paris flight's on hold, although they've totally committed to bringing it back in 2022 at the latest. So in May 29th, which was on a Friday, we received, and also I should note the property was rezoned since the developer acquired it. That rezoning is worth a lot because it enables it to be used for a lot of other things, including Elanco. On May 29th, we received a request for a proposal from Elanco. We were only given 2 weeks to fill it out. It had to be into their office by June 15th because they planned to make a decision middle of July. We knew from our recon very well and verified that we were in stiff competition with Kansas City, which is where Bear is located, and also Winslow, Maine. And they put out the RFP. We are aware of that. Their owner's rep was only able to talk to secretaries of commerce from Kansas, from Maine, and from Indiana. No local government involvement. We would have to represent them. So we knew from the RFP, the first criteria of this multi-state competition is we want to be in a major metropolitan area, and we want to be near an airport. So we talk about those things, and this was all because of recruitment and retention. And Representative Brown, you know we talk a lot about this. This was the reason for regional cities. This is what Northeast Indiana did. This is what Northwest, or Southwest, Southeast, eventually the double track in Northeast, West Indiana, and then East, West, Central, and Central have done to retain employees, to make cool places to live, work, and play for these young people that they look to where they're going to play, where they're going to live, then they pick their job or find a job. So it was for them, it was all about access, amenities, and aesthetics. It's talked about every meeting we went into. Aesthetics, amenities, and access. So at the owner's rep, we had long discussions. They were leaving Greenfield. I wanted to point out to Representative Cherry, they were leaving Greenfield. This was not a consideration. This was going to happen. And I was very adamant, having had a good relationship with Mayor Fuel. I was very concerned about this. And I've made a personal commitment, Representative. I've made a personal commitment, and we've made one on paper, by the way, that we will backfill that site. This is a beautiful campus. I was involved in some of the buildings out there. It's beautiful. The only reason they're moving is to be in a metropolitan area with access, with amenities and the airport. Beautiful building. I went out on the morning of the announcement. Every single meeting I was in, I said, who's talked to the mayor? When's somebody going to talk to the mayor? But I'm embargoed. I'm under a non-disclosure agreement. I can't talk to anybody. I can only talk to their owner's rep. I couldn't even talk to the members of the company. When is somebody going to go talk to the mayor? Doesn't somebody owe them this? It's in Greenfield. It's been a huge employer. We owe it to them. So I just drove out on the morning of the announcement, and I met with the mayor. And I broke it down for him, and he's obviously disappointed. But we are committed to backfill that building and fill in those jobs in to maintain the livelihood of the economy out in Greenfield. I wanted to make sure you, if nothing else, I made that point today. We put forth 2 proposals that met that criteria. First, we had to have 70 acres. And as you know from the deal now, we put forth 45 acres was a 20-acre option that I don't believe will ever be exercised, given we just didn't think they need that much for what they were doing programmatically, but out of respect, we gave them that option. But there's not very many places that offer 70-some acres contiguous for a campus like this. So we offered 2, one being the GM site, which we thought met the bill perfectly, and the second one was a site up in northwest side of Indianapolis by the interstate across the street to the west of Dow, Elanco, now Corteva. This was an amazing RFP. It not only involved a global headquarters. You said, well, there's a global headquarters right now. But this is now global headquarters of the second largest animal health company in the world. That's going to have a big, big impact on Clinton, which is formerly the Clinton Lilly Labs, which is now Clinton Animal Health Labs for Elanco. Huge impact on Vermilion County. And during the process of this, the idea was to consolidate, especially between Kansas City and Indianapolis, consolidate all the manufacturing into one state So they are selling and shutting down the entire manufacturing operation in Kansas City to be in Indiana. So that will go mainly to Vermilion County. It'll go to in Clinton, Indiana. It will also go to Vigo County and Terre Haute. We're obviously making a big impact in Marion. And I don't think I'm violating my non-disclosure agreement in any way, shape, or form, but there's going to be a big R&D presence in Lafayette, Indiana, Tippecanoe County, because there's going to be a big link there for animal health-wise, and what a better site than to be south of the great Indianapolis Zoo. So this was 2,200 jobs. 2,200 jobs, over a $500 million CapEx investment, and these jobs pay average wage of $149,000 a year. These are the biggest jobs we've ever seen. It's the biggest Indianapolis ever seen. It's the biggest any city in the state of Indiana has seen in one project, by far. Certainly the biggest since I've been at IDC in terms of that. And it's long-term significant tax revenue, well beyond anything we do at IDC at incentivizing this deal. So it's a very unique site, unprecedented, job-driven center. The site is job-driven. We have, oh, there he is. It's job-driven, and so we've never done this before with a site, but we can add it in. It was all about the jobs. It just makes the cost per job higher than what we normally see. But again, it was a criteria to make it work. I often would tease with the architects back at my firm. I'd say, when you get done with a project you go after and you don't get it, what's the first thing you do? You come back and you agonize and you talk about, what didn't we do? And you talk to the client, what didn't we do? I've never seen or heard of a business that goes after a project and gets it and sits around a table and say, okay, but what did we do that we didn't have to do, that we could have not done and still gotten this project? We don't know, and we'll never know. These things are tough competitions amongst private sector companies that have a choice beyond paying taxes, beyond things that they're required by law. And then the beautiful part of this was our partnership with the city. We demanded, and it took quite a while to get through, the fact that we demanded they drop the lawsuits against each other. Believe it or not, that was on one side anyway, did not want to do that. But our partner is going to be the city in terms of zoning, and they're putting forth a significant amount of money towards this. The deal at Kansas City, by the way, was over $200 million, so we didn't leave a lot of money on the table. The expansion of the White River State Park, which is beautiful, the Henry Street Bridge, which maybe you've seen in the renderings, that's huge, the pedestrian bridge, and down the road, the city will grant us the land on the East Bank. So we will connect two state park expansions to one another. So there's a lot of amenities in here for the citizens of Indiana, and again, expanding the downtown. So the thought came up to every step we go from now on, we not only have to have the city's approval, but until we pay for the site, we have to have the developer's approval. So the thought of transferring that money now at a time when it's not hugely in demand would be fiscally correct to do, because then we would be able to make our decisions and do things all at one time. And also, it's just good business for us. So I appreciate that. Again, all their incentives are performance-based. That's all we do at the Indiana Economic Development Corporation. We do have some input, Senator Mishra, to you, of course, of how we would deal with this. It's different. It's different than clawing back an incentive that if somebody fails to, after they've made it, to go backwards. It's different in terms of its land. It's different than what we're giving. But we have some checks and balances in here that we can do and exercise. So at a subsequent point in the meeting today, we'll talk about actually the retention. We consider this a new company, and that's how we dealt with it, but they didn't do a new federal ID like DuPont and Dow. Therefore, we weren't able to treat it like that, even though it's very, very similar. So we treat these as new jobs, and the only way we have to pay for that is through retention. But I guess I'd leave you with this last point or question, I guess, that I've thought on many occasions is, what if they left? And they're not. So with that, thank you, Mr. Chairman, for your time. Senator, thank you. Thanks to all of you, and again, your colleagues. And I'd be happy, Mr. Chairman, take any questions you might have.
Any questions on the economic GM stamping plant site purchase? Senator Brown.
Thank you, Mr. Chairman. Thank you, Commerce Secretary, for your presentation. I'm a little confused. So is the 10 acres that will be included, transferred over, the waterfront property, is that now currently the city of Indianapolis? Or is that part of this 91 acres?
It's part of this 91 acres.
Okay, so who owns the remaining 36 acres?
I'm sorry, which?
Who owns the remaining 36 acres?
That will be owned by the state. Thank you for asking that question. It's a very good point that I did not make. That will be owned by the state, and the intention is to develop that, market that, to help make up for revenues that we spent to buy the site.
Okay, thank you. And so with that, when you say, well, the note here that Elanco IADC and the city of Indianapolis will continue working together, what exactly is the city of Indianapolis's contribution to this project?
$64 million to the 45 acres only, so that's within the confines of that campus through their TIF dollars. So they will use that $64 million for road work, for new roads, for utilities, for things that they are allowed to use within the TIF requirements. I will say also that there hasn't been a big deal made about it, but the city's also putting $28 million out of the TIF money for that entire area into the improvements of McCarty Street, the improvements of Oliver Street, the improvements all around Washington Street. And so they're doing another 28 that's going to improve the entire neighborhood. And I will also add that we have the Bright Point neighborhood is a great neighborhood, and the city has actually had long discussions with them, not on this particular project because of the non-disclosure, but on a previous project that looks exactly the same as this one. So we know the neighbors will support this.
All right, thank you. I'm not familiar with that. So the other streets that you just mentioned, I assume they are contiguous to this project?
Yes.
Okay. And then finally, so then does this 20 million out of the Next Level Flight Fund, does this zero out that fund?
I'm sorry, once again.
Does it zero out the flight?
Yes, it would zero out the fund. And I also say from this IDC is paying $7.5 million for the initial down payment, of which we're hopeful to recoup $2.5 million of that money. But we are going to have to take a new look at all of our programs and all the things we offer because we're not able to recoup the $5 million, which we did not have. So we will have to recoup that, and we'll have to do the best we can and try to continue to set records with that shortfall.
Okay, my last question, thank you. My last question is, I think you had said the Paris flight you anticipate coming back in 2022. Is that going to be without subsidies?
No, they'll still be able to, their summaries lasted for 2 years, but they were almost, actually, that's a great question, Representative. I'll get you an answer on that. I think they were close to, their incentives were for 2 years. And I'm pretty sure we were close coming up on 2 years. I remember it was race weekend when we started it, and it would have been up this past race weekend. They canceled it back in April, I think. So they were still eligible for 4 months or so, but it's really, the entire incentive was less than $4 million. So they may be entitled to a fraction of that yet, but then that backstop goes away.
Okay, thank you very much.
Thank you. Do you go ahead, and do you have any further comments on the EDGE credit under the review item?
No, Mr. Chairman, thank you.
Any questions for Mr. Schellinger on the EDGE credit? Mr. Jackson.
Thank you, Mr. Chairman. And this really goes back to the purchase, but could you just describe for a minute, Secretary, about how that will work in terms of retaining the title? Will the state retain the title after Elanco constructs, or do we turn over the title to the land, or just who maintains that?
You're talking back about the site, not the retention. Okay, so on the site, what we're doing there is they have to perform and have to invest $100 million over a 10-year period of time. If they do that, then the site's theirs. We deed it to them. They own the site. We transfer it over to them, and they own the site until they don't perform with that $100 million investment over that 10-year period. Now, the option that I think is going to happen, if I had a crystal ball, and I don't, but if I did, I'd try to predict Notre Dame would beat Clemson this weekend if I had a crystal ball. But anyway, the prediction I have is that it will be bought or turned over to a developer who will build their building and lease it back to them. That's my suspicion, my thought. And it's not bad. I mean, it's very typical in the industry. Now, prior to doing that, they have to have our approval. And they cannot dispose of this property at a profit. So when we would go to look at something like that, and if they were to be looking to turn it over to developers as part of a bigger deal, we would have to approve that, and we would either make sure they don't make a profit or that the state of Indiana benefits by that, not them. Does that answer your question?
Thank you. Any further questions on the purchase site or the edge retention credit? Thank you very much, Mr. Schellinger.
Thank you,
Thank you
Mr.
for your
Chairman.
hard work.
And again, thanks to all your colleagues.
Thank you. Next, we have Ms. Hazlett for Purdue University. You may use the side.
Good afternoon, everyone. My name is Ann Hazlett, and I'm here to speak on behalf of Purdue University. Appreciate the opportunity to join you today. We are here to seek your approval for the construction of a new wildlife area animal care facility at Purdue on the West Lafayette campus. Purdue University has one of the top wildlife and fisheries research programs in the country, and a major reason for that success is a wildlife area that we have near campus. It's 290 acres just outside of campus. The wildlife area animal care building would be a new facility at the wildlife area, and it would include 6 animal care rooms and lab facilities for research on aquatic and terrestrial species. The proposed facility is 4,753 gross square feet in size, and it would replace an outdated existing facility that was constructed in 2 different segments in 1974 and 1993. This new building would double Purdue's research capacity in this field. The construction of this new facility would ensure that Purdue remains competitive when it's applying for federal research funding in this area. In addition, this facility is very important for Purdue to be in compliance with some of the strict federal guidelines that exist for animal care. The estimated cost of this project is $2.7 million. Purdue has already raised $2.6 million in gift funds, and the remainder would be provided by Purdue's operating funds. These operating funds are general funds from the university's existing allocation, so no additional state funding is being requested. I will close by saying that in designing this project, our team really stepped back and determined that constructing a new facility would be a better value long-term than renovating the current building. A renovation of the existing building would require significant and costly modifications to the building layout, updates to the HVAC system, and construction of additional space. We would like to begin construction in April of 2021, and we would hope to be done by January 2022. So with that overview, I thank you for the consideration and would be happy to answer any questions that you might have.
Any questions for Ms. Hazlett? Is there a name to this building? Senator Brown.
Just a quick question. Do you partner with, or you might not know this, you can get back to me, with DNR with their fisheries?
We do, actually. Some of the research that is being done there is research that we are working with them on hunting and fishing. And much of the research that we do, we then use our cooperative extension service to help put out into landowners around the state.
Any further questions or comments? Thank you very much. Thank you. Next, we'll have Indiana Sports Corporation, Mr. Ryan Vaughn, and then Shannon Sullivan with statewide initiatives, and William Knox. Yeah, you want. Thank you.
Thank you, Mr. Chairman, members of the committee. My name is Ryan Vaughn. I'm the president of Indiana Sports Corp. I'm happy to be with you today. I'm also joined by board member William Knox and colleague Shannon Sullivan, who will both speak to some larger statewide initiatives. But I'm here today just to kind of report out on the $550,000 sports tourism grant that you all provide us. That grant is divided really into 3 different categories per grant agreement. The first part of that is $150,000 that makes the state a partner in the overall Big Ten Community Partnership. So just by way of summary, the Big Ten Community Partnership is a financial partnership between the state of Indiana, the Colts, the Pacers, Visit Indy, and it is designed to procure a number of Big Ten championships over certain years. So we're currently, I think, in year 10 of that partnership as it relates to football. We have the football championship secured through 2022 annually. We have the women's basketball championship secured through 2022 annually, and we are scheduled to host the men's championship again in 2022. We are also in a current active bid process, which I'm very excited about with the Big Ten, that would extend our partnership all the way through 2030. And that would be the opportunity to host the football championship every year through 2030, the women's basketball championship every year through 2030, and then the men's basketball championship 4 times over that same period of time. So it's been a tremendous partnership for us, and we're very excited and hopeful that we can extend it. The second half of that grant speaks more to our event attraction efforts. So we use the $250,000 for a variety of bid preparations, rights fees, things of that nature to help us build a robust pipeline of sports tourism events that come in both Indianapolis and communities throughout the state. We are in the middle of an active bid process to host the 2024 U.S. Olympic swimming trials. This would be a first of its kind of event. We would actually build 2 50-meter indoor pools inside of Lucas Oil Stadium. We would host 16 sessions of 25,000 fans over an 8-day period, which of course is nationally and globally broadcast. So excited about that opportunity. Likewise, we have bids out to host the 2023 and 2024 U.S. Masters Swimming Championships at the IUPUI Natatorium. Those events both have thousands of athletes that will spend multiple days in our community with tremendous economic impact. We also had a very successful NCAA bid cycle. So for those of you who may not be aware of how the NCAA awards their bids, they award all 90 championships on 4-year cycles. And so as a state, we actually bid on over 25 different opportunities to host championships over a 4-year period. And we were very successful in our efforts. We were awarded NCAA basketball men's championships first and second rounds in 2024, a regional round in 2025, and we've already previously been awarded a men's Final Four for 2026. We have a golf championship, Division I regional in 23, multiple swimming and diving championships at all 3 division levels, 1, 2, and 3, a water polo championship, lacrosse, Division II, wrestling, indoor track and field, which will be a new one for us. This would take place actually at the Fall Creek Pavilion at the new state fairgrounds, and new indoor track there. So a lot of successful bidding activity. Normally I would be very happy to sit here and report out to you the great economic impact these events had on the year past. But as I'm sure you're all aware, many of those were canceled, and most of our attention was devoted to future pipeline. And I am excited to tell you that the future is very strong. You're probably following the news. We're currently in negotiations with the NCAA for the opportunity to potentially host all of March Madness and, of course, the Final Four this year in Indy, which would be fantastic. And then we will lead into another Big Ten football championship and then the college football national championship in January of next year. So happy to answer questions on any of that, and then defer to my board member, William Knox, on the larger statewide effort.
Any questions for Mr. Vaughn? Mr. Knox?
Yes, good afternoon, everyone. I'm here with you as the chair of the Sports Indiana Committee, which is now transitioned to Team Indiana, which I'll talk to you a little bit about today. My day-to-day activities keep me busy in managing Grand Park in Westville, Indiana. So I've had the great fortune of working with Ryan and his team for many years when we actually created Sports Indiana. And at that time, we tried to be very good stewards of our resources, including the grant funds we received from this body, such that we never hired staff to help manage that organization. In the early days, it was easy for us to navigate the waters of this statewide initiative under that structure, but as we continue to grow and the competition throughout the country with other statewide organizations began to grow, it was very apparent to us that we were going to have to change our model. So over the course of the last probably 2 years, we've gone back and forth with our board as well as Ryan's board to determine the best course of action for this institution. And we came to the decision to merge the two. So approximately 6 months ago, the Indiana Sports Corporation has assumed the leadership of Sports Indiana and rebranded the initiative as Team Indiana. And there is still a standing body that will help govern some of those decisions that are made on a statewide, on these statewide initiatives. But all in all, now we have staff to support all of our activities and initiatives, which we didn't have previously. So Shannon is here to talk a little bit about the grant program, but I'd be more than happy to answer any questions related to the transition of the organization.
Any questions for Mr. Knox? Thank you. Ms. Sullivan, go ahead.
Thank you. Yes, I'm Shannon Sullivan. I'm the Director of Statewide Initiatives and Events at Indiana Sports Corp. and leading our Team Indiana effort. As we know, COVID was crazy and has affected everyone's industry, including ours. And so going into March, we had almost awarded all of the grant funding we had available. We had a full calendar of events scheduled across the state. Then March hit, and one by one, those events were canceled, postponed, moved around. So that kept our grant committee very busy. Our grant committee for Team Indiana is represented by those from Evansville, Bloomington, Shelbyville, Hamilton County, Indianapolis, and that is all at this point. And so those group of people were hard at work as we had money being returned and redistributing it to events as they were relocated. So throughout the course of the year, our committee reviewed a total of 19 applications requesting more than $200,000 for event support. We were able to support 12 of those events, and those events spanned counties, 7 different counties, including Allen, Hamilton, Kosciuszko, Lake, Marion, St. Joseph, and Vanderburgh. The handout that was passed out includes the economic impact from those events. Even with the restrictions and lower numbers of attendance and participating teams, we were able to produce nearly $12 million in economic impact from those events. We include more information about room nights and visitor spending and state taxes on that document as well. On the back side of the document is the full listing of all the applications that were reviewed, the amounts that were awarded, and then ultimately the amounts that were paid out. You'll also see that 8 events have been awarded funding going into 2021, and we still have some funding available as new events are added to next year's calendar. So we've always known how important this grant funding is to our communities and their efforts for hosting events. It was more apparent than ever this year as everyone was facing financial challenges and then the additional challenges of last-minute relocations, and we know that our funding was instrumental in helping those events relocate to Indiana. A few examples are AAU diving moving from Texas to Hamilton County. Ohio event moved to South Bend. Several AAU basketball events moving from all across the country to Indiana, and all of those received grant funding. We know that this funding will continue to be important going into 21 as the financial challenges still exist and the landscape of sports tourism is just becoming more and more competitive as other communities are figuring out ways to return to play, and everybody is fighting for business in a time where it's so desperately needed. So in addition to our event support, the funding goes towards some marketing and promotional efforts. This year that has been focused on our Team Indiana rebranding, including a new promotional video for our state, highlighting all of our member communities, the variety of venues that we have, and the variety of sports that we can host in Indiana. Normally we would travel to conventions to meet with event owners. That was not possible this year, but they did pivot, and we've done some virtual trade shows. So we were able to have a Team Indiana booth at the Teams Conference this fall and met with 40 event owners to learn about their upcoming events, tell them about Indiana, and then share those leads with our partners. Ryan already talked about the NCAA events related to Indianapolis. That's been a highlight for our Team Indiana partners as well. We received awards for 22 championships across the state. Everything from cross country in Terre Haute, swimming and diving in Evansville at the new Deaconess Aquatic Center, basketball in Evansville, Fort Wayne, and Indy, fencing in South Bend, golf in Westfield, and golf in West Lafayette, in addition to the events Ryan mentioned earlier. So at this point, I'm happy to take any questions related to the Team Indiana funding.
Any questions for Ms. Sullivan? Thank you very much.
Thank you.
Any questions for Mr. Vaughn or Mr. Knox too? Thank you. Is Miss Allison Taylor on the internet? She is on the internet. Can you hear me?
Nice.
I can, thank you. Can you hear me?
Yes, we have the review item of the state plan amendment change. The floor is yours.
Thank you very much. Very briefly, we have one state plan amendment review item for you. This relates to our supplemental rebate agreements that we have with pharmaceutical manufacturers and Medicaid. It's actually quite a narrow, limited thing we are doing. We are formalizing these agreements with the manufacturers as contracts in our state system. And we have to notify CMS of this change. This is relevant to our state plan amendment in that we have to capture the date we notified CMS of this new process. So the SPA has no fiscal impact, and if you were to take a look at it, it really is just a kind of a red line in addition of a date. And so that is the change before you.
Any questions for Ms. Taylor? Thank you, Allison. That's it. Mr. Sorrells, is he here? Talk about state police OPEB. Either one's fine.
With me for just a second, please. All right, thank you, Mr. Chairman. Committee, thank you for having us today. With me today is Pam Douglas from the Indiana State Police Human Resources. My name is Charles Sorrells with the Indiana State Police Human Resources. We're very happy to present today and give you an update on our efforts toward the mitigation and reduction of the unfunded liability for the OPEB. Since this was handed to us in 2011, Ms. Douglas and I have been in process and the administration of this reduction since the word came to us that it was going into effect. At that time, we started a partnership with the state budget agency, the governor's office, and the legislative body. And to get us to where we're at today, those partnerships were crucial, and I want to make sure that I recognize those properly to not draw any light to what the Indiana State Police has done themselves. This has been a partnership with the first legislative change actually was in 2011 when we took the initiative to propose legislation for the retiree medical benefit account where each employee when they retire gets $1,000. Instead of that going to the individual, we decided at that point that it was better to push that toward this unfunded liability, and the legislators worked with us to get that done, and that was a huge step for us. The next major legislative change that followed was in 2019 when we were allowed to, once we had our initial nest egg, if you will, of funding pooled together, we were able to then start investing that with an investment policy statement managed through the Treasurer's Office and into an investment funding source that is very much like our pension. And so those funds are beginning to grow and grow at a faster rate now instead of the bond rates, if you will, that they were able to grow at before. To continue on our own things that we're doing with our insurance, we have ensured every year that we don't change any benefits or adopt any changes that increase our unfunded liability. Every year we do something that reduces that unfunded liability. Plus we have things that are mitigators that are beyond our control, like discount rates, mortality tables, and such as that. This year the mortality table actually works in favor of the unfunded liability, it changed, but unfortunately for people dressed like me, it's not real good for us because it means we're dying sooner. And we can all, behind your mask, smile about that, it's okay. But it is a factor that we deal with in our longevity due to our job and different things like that. So one of the things that we always are trying to balance is how do we improve our quality of life for our people that are under our plan, which is right at about 7,000 people, and the fiscal responsibility. So the first thing that I'm just going to hit some highlights on this sheet that you should have been shared with you. There's a couple of programs that we're discontinuing, and one of those in particular is our gym reimbursement program, where we adopted a program a few years ago that we would reimburse people up to a certain amount if they made a minimum number of visits every 6 months. And what we found is that was a small group of people that was able to take advantage of that. And we're going to introduce some other programs to replace that are more encompassing and making more people eligible for a premium discount. Other successes we've had this year is we negotiated a 6% reduction in our administrative fees. We've negotiated a reduction in Medicare Advantage program, where we had moved a few years ago our entire Medicare eligible personnel to a Medicare Advantage plan. One of the biggest things that I can bring you today is that we have, in spite of national trends of double-digit percentage increases, somewhere between 10 and 15% increases in our plan's expenses, we were actually able to hold our plan expenses flat last year, which is a huge savings for the plan. And it shows that our people are shopping. They're looking for services at a discount. They're looking at services that are not just convenient, but they're looking for services that are, one, going to give them the quality care that they need, but they're also making sure that they're not spending money just because it's convenient. One of the things that we're going to look at here in just a minute ties to that directly. A couple years ago, we were asked to look at HSAs, and we have done due diligence on that, and this year we're able to implement an HSA offering for that, for after looking at that and looking at where our bottom line is. So one of the big changes that we're implementing this year goes along with what I was saying a minute ago about making sure that we have things that are inclusive of everybody. We are implementing a premium credit plan for our active people in our traditional plan, our actives and our retirees in our traditional plan. And what that is that we have a actuarial report from Anthem, or actually from LHDR Advisor, that shows that if people go to a doctor, they have an ongoing relationship with a primary care doctor, that will save us about $1,000 a year per person that's in that program. And so what we are doing is, if people are entering into those doctor relationships and going to get an annual physical once a year, they are getting a $100 premium credit on their insurance annually. And so when we see significantly and through other studies that it's going to save $1,000 per person, that's a small investment on a huge return, because we're catching things early and it's going to improve their quality of life and cost us less in the long run, if you will. The other thing that we're implementing is a vaping, tobacco, and cessation program as well, where people will attest to the reduction or the non-use of vaping and tobacco, which was another request that we had. Actually, Senator Mishler was specific on that, where we were looking at different premium programs, and instead of going into a premium rate that somebody would have, we're actually doing a premium discount, or a premium credit, I'm sorry, on an annual basis there. And so people will sign an attestation that they are not using tobacco or vaping materials and go from there, and they're eligible for that once a year. Now, what's nice about that program is that being addicted to or being dependent upon a tobacco product or a vaping product is not something a lot of people can quit cold turkey. And so we have a program implemented through Anthem that if somebody is having those troubles, as long as they complete the program, they will be eligible for the credit as well. still ACA compliant with everything that we're doing. We also are implementing what's called a LARC program, and this is to address pre-diabetic risk factors. This is another cost savings measure that's going to be very beneficial through our program, because heart disease, where the smoking and the vaping is being addressed, and the diabetes part, all those things are contributing to the mortality, or our highest cost factors as well for our department. I've already mentioned that the proposed or any of the plans that are in place now have a negative impact on the OPEB liability. At this time, we're getting very, very closely to having the unfunded liability fully funded, and that should reach fruition within the next couple of years. It could be before the fiscal year 23 biennium that we reach a level fully funded there. One of the things that COVID has brought to us, which was a unintended benefit, if you will, is, as I've shared in the past, we travel our entire state doing education programs for our insurance program. Every employee is required to go to those meetings. And what we did this year, by way of being forced through COVID, is we did those meetings virtually. And so we took it to another step, and we did a lot of these meetings in the evening time, where we were actually able to have spouses and family members that are covered under the plan sit through our educational program as well. So that was a good benefit for us from COVID, if there is anything there. What I can tell you too is that the ISP contributions from the medical benefit account, from the sweeps that we do through our insurance, our biweekly 401H contribution that each employee pays, our retiree drug subsidy, and a sweep from our long-term disability fund, we were able to push $5.46 million toward the unfunded liability this year, in addition to the continuing plan designs that are designed to reduce that OPEB liability on an ongoing basis, year to year to year. And that's about all I have, unless you have some questions for me.
At this time, the membership of the state police, no complaints, or people are satisfied?
Say that again, sir, I'm sorry.
Are people satisfied with the plans they're receiving?
Yes, sir. Yes, sir. And I would also, too, to check back in, when we did the big move with the Medicare Advantage plan, when we moved our retirees to that plan a few years ago, they are still very happy with that. We don't get, once in a while, you can't make everybody happy, obviously. I can't tell you that I don't have any complaints, but for 99.9%, our people feel very secure.
Okay, thank you. Any further questions or comments? Thank you very much for the update and progression of the plan.
Thank you, sir.
Thank you. Next is Mr. Jason Simmons. Thank you, sir.
Good afternoon. My name is Jason Zimes. I'm Conservation Excise Police. Plan for 2020. Sorry, better. Sorry. In 2020, we transitioned 194 of our Medicare eligible retirees to a fully funded plan under Anthem. Because of that plan, we've seen a significant reduction in our expenses, and we have also benefited for a large reduction in our OPEB unfunded liability. I believe it's been about a 35% reduction. Additionally, in 2020, we worked with the state treasurer to change the way our OPEB 115 trust is invested. Most recently, we were seeing a return on investment of about 1.41%, and we are forecasted for the 2020-2021 cycle to be at about 6.2% return on investment. For the year 2021, we are increasing our employee contributions and retiree premiums by between 3 and 7% based on the various tiers that those individuals fall into, with an average of a 3% increase across the board. We were notified last month that the first half of the year, we have also seen a reduction in our active members, their claim data. And finally, we are continuing with our consultant firm that we use and with Anthem and also INPERS to look at additional ways to reduce our OPEB liability, utilizing various education opportunities for our members. Most of that's done electronically, and everything seems to be sailing right along.
Senator Brown, question.
Thank you, Mr. Chairman. Thank you very much. So who is the consultant that you use for your investment?
The investments are handled through the state treasurer's office.
But you said you're working with the consultant firm in Anthem.
I'm sorry, with respect to the OPEB liability, we work with our representative from Anthem and from Gallagher. That's our insurance consultant.
And have you had the same insurance consultant for several years, or is this a new one?
No, the same for several years.
Okay, so I guess the state police, and it took me a while to process this, and you both have you're both under the treasurers, and only recently have you changed your investment plan to move from, I believe the state police suggested a bond type of return to now 6.2%. What changed? Who made the change to your trust investment strategy?
My understanding that state statute made it available to us.
Mr. Chairman, if I can try to clarify. Yeah, I think, I want to say about 2 years ago, the statute was changed that allows kind of the treasurer's office to invest these dollars a little bit differently than they have historically.
Okay, so only these are under there. So how do we do it with all the other benefits that are out there for other state employees?
Yeah, so as you know, INPERS manages pensions funds and now OPEB for the bulk of state employees, and they have traditionally been allowed to, I don't know if this is the best way to say it, but kind of have a little bit more risky investments, equities, things like that, whereas traditionally statute has capped or limited how these OPEB funds can be invested. And so now, with the statute changing again about 2 years ago, it allows the treasurer's office to invest these dollars in manners similarly to how INPERS has been investing those dollars.
Okay, thank you.
Any further questions? Thank you very much for your time today. Thank you for your service, too. Members of the committee should also receive the reports that are listed separately, email or at home. I hope you have those somewhere. So we have a completed agenda on the table. Is there any discussion about the completed agenda? Can I have a motion to accept the agenda? So moved.
Second.
It's been moved and seconded. The agenda, all those in favor say aye. Aye. Opposed, same sign. The agenda is accepted. We do not have any further committee meetings scheduled at this time. I definitely in April, that's when we have another revenue forecast update. So I believe we'll be doing sometime in April, but I don't know if we'll be doing something sooner or not. We'll try and get that out ahead of time or plenty of time to you, but nothing scheduled at this time. Pardon? Oh, do we have to accept the governor's recommended budget? Okay, so I was just told we have to accept the governor's recommended budget, which by statutory, yes, do it, I believe, by the third Monday, which is actually Martin Luther King's birthday, which is a state holiday, so I anticipate it will be before that date that the governor's budget is submitted to us. So we will have a meeting to have the governor's budget presented to us. Thank you. Any questions? We're adjourned.